their providers on the ground piece domestically to adjust to the current environment.
When might the FedEx investment thesis become just a little more stable? I think what they reported a couple of weeks ago really shocked a lot of investors. When does that start to turn the other way?
And that was part of the reason for our downgrade. If you look to the pre-announcement relative to what our numbers were, since the miss was really driven by revenue, $1.50 of that miss was operations. That's the piece that they're trying to attack today. And I would say just given the recent execution, our confidence in their ability to execute with the increasing headwinds is a little bit more lax at this point. So we're looking for, I would say, success at the execution initiatives, whether it's right-sizing the aircraft network, bringing down facilities, essentially just realigning their network, not only for the current environment, but obviously the eventual pivot to term.
모빌리티 혁신과 드론 메카 도시를 꿈꾸는 스마트 아일랜드, 바이오, 코스메틱 산업의 미래를 이끌 천혜 자원의 섬, 기후변화 시대를 미리 준비해온 탄소 중립의 땅, 전 세계인이 자유롭게 드나들고 내 외국인이 차등 없이 투자 혜택을 누리는 곳, 인베스트 제주.
All right, Mattel catching the best Pokemon of them all. The toy maker securing a franchise deal to make Pokemon toys under license. This is, I would say, yet another big win for Mattel and CEO Nam Kreis. They're going to report earnings tonight. This has just been, in addition to the revival of the Barbie brand, this is just another feather in the hat of Anand in that team over there. This is just, it's a home run deal. Essentially just really stealing out from under the nose of Hasbro.
This is massive. You've got an international brand, one that has had so much success across gaming and some of the digital spaces as well, has had a successful entertainment side of the business that directly dovetails into how many people want to buy the toys over time. And I was one of those kids growing up. I had these toys.
That was your generation. That and
we had the Pokeballs.
Power Rangers.
Yes, they had one of the most virally successful AR apps and game experiences. You remember back in 2015, 2016?
Yes.
People would just stop in the middle of the
On
street.
people's lawns,
Right.
trying to catch a virtual Pokemon.
There you go.
My generation, it was Bugs Bunny, like in the mid-'80s, late 80s, Bugs Bunny on Saturday morning. No AR.
Well, no AR. Yeah. Oh man, the dark days. No AR.
Porky Pig.
Yeah, exactly.
That's all, folks.
And lastly here, McDonald's is bringing back the beloved McRib pork sandwich for what it calls a farewell tour here. Oh gosh, okay.
You should call this the McHeart or the McShoulder, because if you Google search what's in that, it's not actual rib. I think McDonald's has said this in the past. That is not rib. It is a mashup of all these different parts of an animal slathered in. I will give this, that barbecue sauce in the McRib is very, very good. I'm hoping, Brad, they are going to pull this off the menu and start selling a real rib product like Arby's is out there right now selling. Love me some Arby's rib.
But you've been telling me that to this point, the McRib is actually a McScrapple.
Yes,
essentially what you're telling me.
If you go online, you can see it's usually a stripe, heart, and shoulder all mixed together. I'm just recording myself.
Look, it is kind of tasty sometimes.
McHeart. Let's order a McHeart for lunch. Give me a McHeart.
No, well, thank goodness for the farewell tour of the McRib. We hope it's well received, perhaps among those who celebrate McRibs out there in the world.
Maybe with a McCalorie. 520 calories here for the McRib. All right, let's stay on all things economy and the consumer. Strikingly different tone from shipping giant UPS this morning on its earnings report compared to longtime rival FedEx. UPS showing good growth in the U.S. and reaffirming its full-year guidance ranges. This comes hot on the heels of FedEx badly whiffing on earnings and uncorking a fresh restructuring plan just a few weeks ago. UPS CFO Brian Newman just got off his earnings call and joins us now. Good to see you here, Brian, as always. Just for the lay investor out there, these stories between a UPS and a FedEx are now strikingly different, like I just mentioned. Why do you think you and your team are out executing a FedEx?
Hey, Brian, good morning. It's great to see you. Listen, we have a mantra around here, which is control what you can control, and we've been really focused on doing that over the last couple of quarters. The macros have been challenging domestically and particularly internationally, but we've been focused on, with softer volumes across the world, really, how do we ensure we drive the right pricing mix and dynamics and also control the cost? By doing that, you protect your margins and deliver to the shareholders.
And Brian, I just want to stay on that before we jump onto the broader quarter. So you're not out there closing sorting facilities, laying people off, right? I just want to make sure I have it right.
So we are tightening the belt, certainly at the corporate. We spend a lot of money in G&A. We've been tightening the belt there, but we've been doing that for a couple of years, trying to right-size the business. Carol introduced a better, not bigger strategy to the company, and what that really is, optimize the volume that comes into the system so it's more profitable, and then take the cost down. So we have been certainly right-sizing the business over the last couple of years, but no, we're not closing sorting facilities right now. We have the ability to take our variable costs down should the case arise.
And so where are you seeing continued strength within the business and the customers that you're servicing right now?
That's a great question, Brad. The healthcare segment is a particularly strong one. We're doing very, very well there. As you think about the small and medium business, that's been a core focus over the last couple of years. We've been addressing the capabilities that those customers want, and by doing that, you create a wonderful environment for a very profitable customer. So we've been focused on the SMB, small and medium business, the healthcare segment, and then overall, trying to look at that international business because there's lots of growth opportunity there for us.
We've been talking a lot about FX headwinds that companies are seeing right now. When you think about that international business, of course, UPS is going to be rolling out some pricing increases. This also impacts the international segment in December, I believe, and that's really going to be reflected as you finally get into 2023 as well. What is your anticipation around where the consumers and the strength that you were just laying out, where they'll continue to take that price increase?
So we announced a price increase for next year at 6.9%. That's supposed to be representative of a combination of inflation as well as the service we provide. So that'll help drive the base rate in terms of the pricing equation. As we think about the currency impact that you mentioned, Brad, the currency impact in the quarter was about $82 million. So it is a meaningful headwind on our international business, but we're effectively offsetting that as we manage the portfolio across the domestic business and then across some of the other segments.
Brian, I recently spoke to another Brian Cornell over at Target for our All Market Summit conference last week. He said the holiday season he's expecting to be pretty good. What's your read on things?
So Brian and I used to work together at PepsiCo, so I know him, and Target is a very important customer for UPS. I actually think it's going to be a decent peak season. We're ramping up right now. We're hiring. We hire over 100,000 people for the peak season to get ready. And with customers like Target, we're out there committing to them that we're going to be there with the excellent service that UPS provides. So I think that, Brian, the peak season, our peak season volume goes up 50, 60% from a normal run rate. So it is a meaningful increase. But as we think about peak this year, you don't have the low inventory levels that we saw last year, which drove an earlier peak. People were rushing out to buy because they were afraid the inventory wouldn't be there for the holiday season. This year, inventories are much higher at the retail stores, so I think it'll be a bit of a later peak, Brian.
All right, competing against Santa Claus-like efficiency there in the logistics business. When you think about some of the future investments as well there, Brian, and going out into next year and even beyond, what are the investments that you would like to see the company get right the first time in order to build a logistical network and a system that can really see its margins excel over the future?
So it's a great question, Brad. The digital investments we're making, it's really shifting dynamic of UPS. Old school package delivery to now it's more of an orchestrator of volume from end to end. We're putting investments into things like RFID technology so that every package in our system will have a code on it that we know where it is. And if there's nothing more frustrating for consumers or customers when they lose a package or they have an issue, they want to know where that package is. By deploying this kind of technology, we're going to be able to tell people where your packages and how can we recover and make sure we get them there on time for when the customers want them. And we do that at an incredible mid-90s% in terms of on-time delivery.
Brian, I made this comment earlier on the show before you came on, and I said UPS is benefiting from, of course, having you as CFO, but also Carol, too, longtime CFO of Home Depot before she came to you. Am I off base there? Are you guys just looking at the quarter or your business differently than other big public companies?
Brian, it's wonderful to have a boss who used to be a CFO because we have great conversations. But Carol has done an amazing job shifting the culture. So as we think about the future of UPS, yesterday's UPS is not going to get us to tomorrow to where we want to be. We're a 115-year-old company, very proud of our past. But Carol is shifting the company to a place called better and bolder. The bolder is growth and margin improvement. And so where is that going to come from? Areas of basically leaning into the most attractive parts of the market. I mentioned SMB, margins are great. It's a very attractive area. Healthcare, that's a high growth, high margin area. International, we're actually number 2 and 3 in a number of markets overseas. So we're focused on stealing revenue share, value share as we call it, and going out there. So we're putting our investments in those areas that will be accretive from an investment perspective.
UPS CFO Brian Newman, thanks so much for joining us here this morning and breaking down the most recent quarter. Appreciate it.
Thanks, Brian, Brad, thank you.
나 진짜 재밌는 걸 보고 싶어? 그 여자 누구야? 그 여자한테 돈도 받았었어? 그럼 네가 도와줬어야지. 네가 해결하는 거야. 응?
Welcome back, everyone. It is time for Cut the Time. We've got 3 stories, 1 minute each. We start with this today. Warner Brothers says the cost of its scrapped shows and sitcoms could total $2.5 billion. This is as it restructures itself financially. Now, the thing to remember for so many of the production houses, as they have been shifting into streaming, there's a ton more data that they're being able to leverage to really determine whether or not a show, even before it goes to production, is going to be successful. Which makes it even more alarming, perhaps, that there's a $2.5 billion hit that you could see when you are having that massive shift towards a streaming platform, launching that streaming service, and then actually forecasting what will perform well in that environment too.
Yeah, look, there's just continues to be a rapid changes in the environment, how content is consumed, of course, led by the streaming movement. And I just think a lot of these companies, legacy media companies, are realizing there's still a lot of bloat inside of them. You have one person that reports to another person, and they all report to one other person. There's just too many people in there, given this changing dynamic. So again, I think you'll probably see more layoffs or more changes like this.
And is there a change in the binging trends as well? Is the business of binge, is that kind of a thing of the past now?
No, we're all binging.
Are we still watching?
We're all binging.
We're still binging?
Yeah, I'm definitely binging.
Okay, all right, cool.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Brad Smith. Julie Hyman has the day off. It has been an earnings-heavy morning, but let's lock in on some breaking news crossing the wires just about right now, as you're seeing all 3 markets up higher on this. That is consumer confidence, Brad, coming in from the conference board.
Yeah, that's right. 102.5 is the reading that we just had come in from the conference board here. And as we're continuing to look through some of the data and get it all refreshed on our side, this is particularly interesting to see how the markets will react to this as we move on throughout the rest of the day. Right now, the Dow Jones Industrial Average, you're still seeing that hold on to gains, still net positive by about 0.5%, a little bit more than that. The S&P 500 still holding on to gains. That's up by about 0.9%. And the NASDAQ Composite, that's been the leader largely throughout the day here, and that's up by about 1.5% at this point in time. But again, consumer confidence coming in at a reading of 102.5 here this morning. But we're going to continue to see if we get even more of the data that rolls in from this report, and we can add a little bit more context to this as well.
Yeah, consumer confidence, interesting. Brad, you look at these quarters from Coca-Cola, Sherwin-Williams, these companies are out there raising prices, and the consumers, by and large, they've been able to withstand these prices.
Yeah, but this is still a miss on what was actually estimated here. We were looking for 105.9, so coming in at 102.5. The market's right now still holding on to some of the move higher. And of course, this is kind of permeated from yesterday's trading activity and even last week with this little bippy bop bounce, if you want to call it that, where we have seen, of course, in this larger bear market, at least these bounces in the near term, and a larger question of where consumers sit within that and where where the strength of the consumer is, where demand is actually coming in from. And I think that's a lot of really what's spelling out how confident the consumer really is at this point in time. You see demand is far different, regardless of with the industries that we're looking at. Demand for travel, far different than demand for even Coca-Cola, as we're talking about. Even though you may see it actually show up in the results and outpace some of the expectations for the companies on the equity front have actually been lowered. So it's a question of, all right, where will the consumer continue to see some of that strength, even as we're continuing to discuss the risk of this sector?
With the DBS CIO Liquid Plus Fund, you will have the optimal blend of safety, liquidity, and yield.
Coca-Cola trading up after its Q3 earnings beat prompted the company to raise its full-year outlook. However, Coca-Cola also warned it expects to keep raising prices with inflation and says commodities will likely remain volatile. Joining us to break down the latest results is Wedbush Senior Vice President of Equity Research, Gerald Pasquarelli. Gerald, good to see you. Your take on this Coca-Cola quarter.
Thanks very much for having me. Was a really good print. Like with Pepsi, who reported last week, we suspected that the earnings season for the non-alcoholic beverage companies was going to be very favorable. This is something that we continue to see in scanner trends, looking at U.S. retail data in particular for soda and for carbonated soft drinks. And so I think that these results are a continuation of what this company's been able to deliver for over the first half of the year, and it reflects the trends that we're currently seeing in offtake consumer trends. So the guidance raise was favorable, and I think that from what you're seeing in the share price performance, it's well received by the street.
The beverage industry has certainly been one that has an acquire to grow annexation around it as well. Is there an area within the Coca-Cola business right now where you believe that there's perhaps some type of budding new beverage that they need to add on to their portfolio in the near term while valuations are attractive?
I don't know. I think they've done a good job with rounding out their portfolio, and under the current management team, this has been a team that's been very quick to cut underperforming SKUs in a relatively short period of time. I think they're getting really strong performance in their zero sugar offerings, and they're getting really good price pack architecture. So I would say that based on the way things are trending and based on the amount of pricing that they're getting, that I think that they are looking pretty favorable headed into 2023 here.
Yeah, Gerald, you mentioned Coke Zero. Coke Zero in the most recent quarter up 11%. That number really stood out. But on the topic of prices, how much more room does Coca-Cola have here to raise prices?
It's a combination of rate as well as price pack architecture, right? So you'll put less volume into a bottle, you'll sell for the same price with lower pack sizes. Coke does this better than anyone, and so I think when you look at their revenue growth management capabilities, I think when you get into 2023, it'll be a combination of taking the right amount of rate increases, but really looking to leverage their revenue growth management through these price pack architecture initiatives, again, which they're arguably better at doing than anyone. So I think there's room to run here. On the earnings call, it certainly seems like there's the potential for this pricing to at least maybe sustain through the early part of 2023, which would put this company on a good path to deliver on its objectives.
Do you believe that pricing strategy is also going to need to be flexible internationally, especially considering the hit in currency that they saw in this most recent quarter?
Sure. So that's a good call out. With 66% of their sales coming from international markets, Coke is more exposed to a strengthening U.S. dollar, and therefore they will have a larger currency impact to their reported results. I think that if you look at the broad pricing across most of their global markets, it's all up double digits. In Europe, in particular, where there's been some cause for concern, just given the outsized inflationary pressure that those consumers are realizing right now. there will be the need for them to continue to take pricing. It'll just be interesting to see how much this outsized pricing has on volumes and demand elasticities over time. I think that if you look at the current trends in their developed markets, they're really getting great pricing across the board.
It seems, Gerald, that Coca-Cola has now found a new stride on product innovation. They have a lot of stuff coming to market over the next 6 to 12 months. Are there a couple products that you view could be a home run?
I think the Jack Daniels and Coca-Cola RTD cocktail could be something interesting. They're rolling it out in Mexico to start, and then they had mentioned that they're gonna come to the U.S. with Jack and Coke in spring of next year. And when you just look at the brand equity of the Coca-Cola trademark as well as Jack Daniels, and you look at some of the trends within alcoholic beverages, in distilled spirits in particular, where prepared cocktails are the fastest growing segment, that could be something meaningful, just given the brand equity of both of those products.
Could not agree more, Gerald. I was just discussing that earlier when we were talking about it at the top of the show. All right, so aside from RTD, there is this entire sports drink category too. And within that sports drink category that has been highly competitive, I've just been keeping an eye on Body Armor within this as well here. You know, where for the growth in that category can Coca-Cola continue to make some of their own headway?
I think when you look at Body Armor right now, they're facing incredibly difficult compares, and that's kind of resulted in a slowdown in their dollar sales. At least that's what we're seeing in scanner data. If you look at the path to more favorable comps, it'll get easier towards the middle of next year to the back half of next year, and so that's just something to take into consideration. That Body Armor was a robust growth story. They were making really strong rates of market share capture when Coke acquired the company outright, and so I think they're just going through some very heavy, difficult, some increasingly difficult compares, which will just need to be cycled and probably turn to a benefit towards the back end of the year.
Within your coverage universe, are there other companies that resemble what Coca-Cola is doing now, that they're now starting to innovate more, they're having success pushing through price increases, and there's just a sense of stability to the business?
I think within non-alcoholic beverages in particular, we saw it with Pepsi last week, and when you look at the scanner data, we're seeing it with Keurig Dr. Pepper, who will report earnings on Thursday. There's similarities insofar as the consumer is still showing the ability to pay up for these brands that have strong equity. And so that's where the similarity is. When you look at the makeup of revenue growth for all three of these, traditional non-alcoholic companies, they're all price-led. It's really helping to offset this outsized level of commodity inflation that we're seeing. And so I think the narrative is going to continue to hold constant. As long as one company is able to get price and drive mix, I think it's going to be a rising tide lifts all boats scenario, at least over the long term.
Wayne Bush, Senior Vice President of Equity Research. Gerald Pasquarelli, thanks so much for joining us to break down Coca-Cola this morning.
Thanks for having me.
Be amazed by your child for life. New Nan Supreme Pro HA with 5-MO complex and gentle protein. Support your child in every possible way.
Shares of Tesla, they're up after a surprisingly bearish take from Morgan Stanley. The bank cutting its price target to $330, down from $350, citing a highly volatile economic environment and anticipating unexpected headwinds. And of course, this call comes from our friend of the show, Adam Jonas, over at Morgan Stanley, always a market mover on Tesla. He's still staying bullish, of course, on Tesla. He's been a longtime bull in this company, but really noting for what he's saying, quote, making room for unexpected headwinds in the current economic environment. I'll argue, Brad, some of those unexpected headwinds are coming out of China. When we talked about China was yesterday, Tesla cutting prices in that China market. That is a complete U-turn from what Tesla had been experiencing last year and even the first part of this year.
Right, and for Tesla, they have to acknowledge what's happening in the region too. It sounded like when they were on the call that they didn't want to really discuss what is really taking place within that region in China. I mean, you have so much competition that is being brought online that much quicker, that is improving their capacity for production, improving their relations with customers in the region too, who have the propensity to buy some of the electric vehicles either on the mass market side or on the more expensive side. And the propensity right now is leaning towards some of the homegrown brands in the region too. Tesla doesn't want to acknowledge that, of course. They want to continue to focus on their products, but I think it still is a realization that has to be factored in to what their forecasts are actually looking like in the region too.
Right, I was on this too. Yesterday I mentioned that Xpeng is really going toe-to-toe with Tesla in China, and I got raked over the coals on Twitter for it. I do think, folks, even the Tesla bulls, pull up some of the specs on these Xpeng vehicles. They are very impressive. That technology package in that car is very, very impressive indeed.
And everyone, switching gears here, let's take a look at some of the market activity that we've been tracking here. Out of the gate this morning, the Dow Jones Industrial Average, at least about 38 minutes into trading, holding on to gains, and this after what was a weaker than expected consumer confidence reading from the conference board here this morning. But as of right now, the Dow Jones Industrial Average still up by about 110 points. Also, you've got the NASDAQ Composite, that's higher by about 1.4%, and the S&P 500, you're seeing that hold on to gains to the tune of about 0.8% here. Also, checking in on some of the other activity that we're seeing here on the day, we saw some electric vehicle, we'll categorize it as electric vehicle earnings that have come out, but GM really talking about their market share within this most recent quarter. Shares are holding on to gains of about 2.4%. That electric vehicle market share reaching about 8%, they said in this most recent report. We're also going to get results out from Ford, and that's going to be coming later on this week as well. And so as of right now, holding on to gains of about 1.4% there for Ford too.
My morning moments start with my favorite cup of Nescafe 3-in-1. With its signature freshly roasted coffee aroma and taste, I am ready to go.
And whatnot. This full court press that is coming on now, is it late? Should you have done it sooner if Halloween is the time when you thought people should be vaccinated and only 20% of seniors are at this point?
Yeah, so let me be clear. I mean, Halloween is not a magical day. I mentioned that day because I was thinking about the fact that many families, including mine, are getting together with their families for Thanksgiving, and obviously Thanksgiving about 3 to 4 weeks later. But the bottom line here is that if you miss the Halloween deadline, getting vaccinated in November is still a really good idea. But we have been pushing and we've been getting the word out and we've been doing a lot in the last month, so it's not like we've waited until now. Obviously today was the day that the president got vaccinated based on his schedule, and when I say his schedule, 3 months after his infection. So that's why today was a moment to be able to.
The president seemed to express some level of frustration, may not be the right word, but his remarks seem to, maybe exasperation is the right word, about divisions when it comes to people wanting to get vaccinated or not getting vaccinated. I think at one point he said, yeah, I'm having to talk about this again. Is there a sense of frustration or exasperation about where things stand with, the willingness of the country to roll up their sleeves again?
No, I don't think I would use any of those words. What I would say is that these are public health matters. And what the president said, which I thought was exactly right, was this is not a political issue. This is not a partisan issue. This is a public health issue. Like, we want to protect people. We want to protect Americans. We want to protect American lives. And right now, what we know, based on the best public health science, is that COVID is going to be this, by getting people vaccinated, we can prevent more deaths over the next 3 to 6 months than by doing anything else. And what you heard from the president was a very clear statement that that's what we are focused on as an administration. Because that is the right public health response at this moment to make sure we're protecting people, particularly seniors who are at high risk of having bad outcomes.
You mentioned the rise that we're seeing in pediatric respiratory illnesses. I think in some states right now there are limited ICU beds. 75% of hospital beds for kids are now filled. How concerned are you that this limited capacity will be stretched even more? And what can you say to parents who are concerned that they may have trouble finding care if their child has RSV or the flu or COVID?
Yeah, it's a good question. So obviously we're seeing the rise of 3 respiratory viruses, all of them going up around the same time. That's concerning. So here's the big picture. The good news is for 2 of the 3, we have vaccines that are highly effective at preventing serious illness, COVID and flu. So first thing, what I would recommend to parents, which is what I've done as a parent, is gotten my kids vaccinated, right? Because if you can get them vaccinated against flu and COVID, that takes 2 of the 3 issues off the table. It also creates more capacity in the healthcare system, and it just makes it better for everybody. You know, on RSV is a virus that has been around forever, but it's been around forever. It is, under normal circumstances, about 90% of kids end up getting RSV at least once by the time they're 2. Because of the pandemic, some of the kind of standard patterns have been disrupted, so we're seeing a lot of RSV at once. My recommendation to parents is, you know, for most kids, RSV is very, very mild. And my recommendation is, you know, pretty standard stuff, right? Avoid sick contacts. If your kid is sick, keep them at home to prevent spreading it to others. You know, unlike COVID, which is purely airborne, with RSV, a lot of it is surface transmission, and therefore washing hands turns out to be actually quite a good thing for RSV. So basic kind of infection control, respiratory precautions goes a long way to controlling the virus. And, you know, and again, we're looking at and we're really tracking healthcare capacity very, very closely across pediatric hospitals. And obviously, if hospitals need help, we will step in and help them to make sure that all kids across America get the care they need.
Dr. Jha, would it be more accurate to say that the pandemic has moved or evolved than to say that the pandemic is over? The president said that obviously several weeks ago, but that declaration doesn't seem consistent with the conditions that you're describing.
Yeah, what the president said several weeks ago also was he said COVID is not over and we still continue to fight COVID, and we do. And what we're describing today, what the president described today, what I'm talking about today, is that COVID continues to kill several hundred Americans every day. Right now, it is probably the 3rd leading cause of death among Americans, and probably the #1 cause of preventable deaths among Americans. So it continues to be a substantial challenge, and we are focused on fighting COVID every day. Well, certainly our team is. Literally, that is what we focus on. And the president continues to be focused on this. And so whatever terminology we use, I think the bottom line is COVID continues to be a substantial problem, and we're out there fighting it.
It's more than just terminology, isn't it? I mean, there's a message in saying that the pandemic is over that just doesn't seem, at least to my ears, to jive with saying COVID is still a problem.
Well, yeah, even back at the Detroit Auto Show said COVID is not over, COVID continues to be a problem. And that's the way we have seen it, that COVID continues to be a challenge, and our job is to continue fighting COVID, to do everything we can to reduce the number of people who are getting infected, getting seriously ill, and dying.
Just a couple questions. The first, as you were talking about long COVID earlier, has the president or First Lady at all experienced any long-term COVID effects? Can you talk about how he's been doing since recovering from COVID? And also, I just kind of want to double down. When the president was talking earlier, he said that no one should be dying from COVID, and that if they get the shots, it is 100% avoidable. But that was a little different than the message that was being put out earlier during the pandemic, which is that it lessens the chance, right? But he said today 100% that if you do this, that you will not die from COVID. So I just want to clear that up. Is that how it is?
Yeah. So in terms of the president, I'm not his personal physician. I've met with him, chatted with him. He seems to be doing great, but I have not asked him. And again, you get that from his personal physician. But I'm not aware that he's having any persistent symptoms. But again, I'm not his personal physician, and I have not asked directly. But he seems to be doing great. In terms of what the president said on preventability, here's what we know. We know from large-scale studies that if you're up to date on your vaccines, and then if you have a breakthrough infection and you take Paxlovid, mortality really does start approaching zero. Like we have seen in very large cohorts of patients who've gotten COVID, that everybody who's up to date, and then if they have a breakthrough infection gets Paxlovid, like mortality numbers are just exceedingly low to a point where they probably are very, very close to zero. So I think the president, I remember his exact words were that nearly all deaths are preventable, and I think that's exactly right. which is first of all really stunning, thinking about how much progress that is in a pandemic where you had a virus that was killing thousands of people a day when the president came into office. We're now at a point where if people use the tools that we have made widely available and free, we can get that close to zero.
Really quickly to double back on Paxlovid, because there were reports earlier in the year that it's not as effective in those who are healthier patients. And you just mentioned that you're seeing something different when they take it.
Yeah, so here's what we know about Paxlovid. The biggest benefits are in the highest risk people. By the way, that's true for every medicine, right? Medicines have the largest benefit in people who are at highest risk. Lower risk people have smaller benefits from Paxlovid. I think, and I've said this publicly on multiple occasions, I think the data is overwhelmingly clear that basically everybody over 50 benefits from treatments. If you're a 52-year-old who's up to date on your vaccines, your benefit is going to be small, but the costs of taking it, meaning the side effects, are also trivial. If you're 75, the benefits are going to be large, and so I believe everybody's better off taking it, but the benefit is bigger for people who are higher risk.
I do want to ask about vaccine mandates, and I see this decision from the other day. Should children or school districts require COVID vaccines, and should the military require COVID vaccines?
Yeah. So we believe. So let's talk about children first. That is very much a local decision that should be made by local school districts, by cities, by mayors, by local officials who usually make those decisions, and sometimes they're made by state officials. But ultimately, I personally, and I've said this about other COVID policies as well, that I think is extremely important that those decisions be made at the local level by local leaders. In terms of the military, that's a decision that the military leadership makes based on what the military leadership decides is important for a ready force, and so the Secretary of Defense has made that decision so far in terms of that. What do I think? I think those decisions should be made by local officials. And I am not a local official evaluating, right? Because it's a series of factors that go into making those decisions, including community input, including what people want in that community, looking at the data. I'm not a local official. I'm not tasked to make that decision. I have not, so I don't have an opinion on what local officials. But the key is that the local officials should be making those decisions.
I wanted to ask you about your impression of how India has handled the COVID crisis. And secondly, there was a talk about Quad cooperation with India manufacturing this COVID vaccine and distribution in the US and Quad distributing to the rest of the world. I think the progress in that respect has been quite slow where we are on that part.
Yeah, so what we know is that India has been, because of its incredible manufacturing capacity, has been a major exporter of vaccines. My understanding is, and again, I've not looked at this very closely, my understanding of why it has slowed a bit is because global demand for vaccines has slowed because, again, we produce a lot of vaccines. But I think that Quad partnership is really important, certainly important to this administration, and I think India is an important manufacturer of vaccines for the world, and not just for India itself. It's really important.
Follow up on your answer to my colleague Mary's question about RSV, and you said for COVID and flu, there's vaccines. You recommend that for parents right now. Would you also recommend parents go back to masking for kids going to schools? What are some of the other lessons of the last 2.5 years for parents as they're dealing with what seems to be pretty rampant sickness right now across the country among that age cohort group?
Yeah. So right now we don't have a vaccine for RSV. We might, and there are a couple I know that are being worked on, but I don't have any insights on their timing or when they'll be available. And so I think the most important things on RSV, when I think about the data we have on how RSV spreads.
Being broadly kind of not just RSV, because you said there wasn't a vaccine on this, but just the flu and sickness that's going around right now. What other things would you recommend going back and looking at what we've been through the last 2.5 years? Would you say that parents should be masking their kids again in schools just to keep sickness down right now?
Yeah. What I would say is, there's a series of respiratory precautions that we know help. So I think the number one thing that is most useful is when people are sick, keeping sick kids home, right? That's probably the single most important thing you can do to prevent spreading, and avoiding sick contacts in general. So I think that's super important, which of course as a parent still is super challenging. But that is probably the single most important thing. I do think, and again, different respiratory viruses are different, but both flu and RSV, there's good data that hand washing and hand hygiene is really important. So I think surface cleaning and hand hygiene is very important. We also know masking definitely helps for COVID. And so there's a series of things that parents can do. And my feeling is that probably the single most important is, again, that avoiding the sick contacts and keeping kids home when they're sick. But there are other things that parents can do as well.
Thank you. I wanted to follow up quickly on a question that my colleague just asked, and then I had another one. Moments ago, you said that it's extremely important that these vaccine decisions for school children be made at the local level. I'm curious, though, does the president believe that it's prudent for states like Kansas or Florida to leave that decision to parents? Or is just the White House agnostic on this question and just leaving it to local officials?
I think most of these decisions have been made. I mean, so when I think about vaccines in general for school-age kids, my understanding has been that they've always been made at the local level. That's what I think where these decisions are best made. Local officials obviously have to engage families and parents and understand their views. And so I think, my feeling has been, and by the way, I've made this point for the last 2 years before I came into this administration, and I continue to make it now, that these are local decisions made best by local officials who understand the communities in which they work and the communities that they lead.
And then you also mentioned earlier in the briefing that one of the reasons why it's so important for the United States not to neglect a global response to COVID is because each of these variants have come from outside our borders. I'm wondering, do you or the White House have any response to the fact that the NIH just last month awarded another grant to the EcoHealth Alliance to study back coronavirus in Myanmar, Laos, and Vietnam? Is that type of funding, given some of the questions that we still have, is that prudent?
Yeah, I will tell you, I don't know much about, and again, the White House, we don't get involved in decisions that NIH makes about what research to fund, but I don't know specifically about those grants, so I just can't comment on that.
There's been substantial work on a potential pan-coronavirus vaccine, including by Walter Reed scientists. What are you seeing in terms of the data on these clinical trials and indeed the protocols?
Yeah, so it's a really good question, Michael, and gets at a bit of a broader perspective, right? Which is, okay, so we've updated the current vaccines, they're great, but the virus will continue to evolve. That is one thing we know about this virus. And if we really want to get ahead of this virus in a very substantial way, we want to build pan-sarbecovirus vaccines or pan-beta coronavirus vaccines that really will be variant-proof. And there is really good work being done by scientists within the U.S. government, but also being done in academic labs across the country. And this has been one of the areas where we need congressional funding and support. We have a project that we've described, which really speeds up the availability of those vaccines for the American people. I think in the long run, it's absolutely essential that we develop both pan-sarbecovirus or pan-coronavirus vaccines and mucosal vaccines, because mucosal vaccines are going to be the ones that are really going to block transmission with a very high degree of fidelity and bring the level of infections down. It's going to be very hard to do those things without congressional funding. So one of the things that we have asked Congress for funding for is for support to speed those up, because the science is so promising. And because science is promising, and because it will take many, many years for all those to get developed and come on the market on their own, we think it's a really important role for the government to play in both speeding up the science, speeding up the clinical trials, and then the ones that end up working out and working well, bringing them to market with the American people much more. Thank you.
Is it still the case that the Russians are still being non-responsive to the offer?
I believe the president said this as well, that we're in constant communication through multiple channels.
with Russia, as I mentioned at the top of my comments of the briefing. So look, as I've said many times before, this is a priority for us. It's going to continue to be a priority for us. And but what I also said at the end of the statement I made at the top is that we need Russia to negotiate in good faith.
Since they're not responding to the offer or making a serious counteroffer, is there any consideration of changing the U.S. offer that's on the table?
Look, going back to your first question a little bit, look, it's fair to say that we have been in contact, right? And the lines of communication continue to be open. I'm certainly not going to negotiate from here on this podium or in public, and so therefore we're not going to get into greater details. But again, we have been very clear that Brittany Griner and Paul Whelan should need to be home. They should be home right away, and the president's going to do everything that he can to bring detained Americans back.
On another topic, I wanted to follow up on a question my colleague asked you last week about I was just wondering if the White House had been briefed on the case of the U.S. Marine and his wife who are facing accusation of abducting an Afghan child during the withdrawal. I know the Pentagon, Justice, and State are aware of the situation. Obviously, the couple says they have legal custody of the child. But has the White House been made aware of the situation? Is President Biden aware? And do you have any reactions to this?
Yes, I remember Darlene asking me on the plane, I believe on Friday. So we do have an update for you here. We are all concerned with the well-being of this child who was in the first instance, as you just said, orphaned in Afghanistan, to be clear, and who is at the heart of this matter for 3 years later. I won't have much to say in the situations involving minors. The United States took extensive steps to reunite the child with her next of kin in Afghanistan after she was orphaned. The United States has now taken steps to make its position on this matter clear to the appropriate authorities. Again, I'm not in a position to comment on this any further, on any litigation that is currently occurring, and would refer you to the Department of Justice for any further comment on this.
Following on questions on Griner, there's sort of been a sense that the negotiations couldn't enter the next phase until this appeal process was concluded. So can you discuss a bit how today's ruling may have impacted negotiations?
Look, I mean, we've been very clear about this. We're not going to certainly negotiate in public. Look, we are disappointed about what we saw today, but not surprised by the outcome. As we have said multiple occasions, these judicial proceedings are a sham. And look, this is a priority for this administration. This is a priority for the president. This is a priority for Jake Sullivan, National Security Advisor. You put out a statement this morning. And this is a priority for the Department of State. And we are going to continue to make this a priority and get Brittany Griner home as soon as possible, and also get Paul Whelan home. Again, I'm not going to negotiate in public. I'm not going to go into details of the process. But again, this is a priority, and we need Russia. We are asking and telling Russia to negotiate in good faith.
A question on Russia and Ukraine. The president, we heard him say earlier that it would be a serious mistake for Russia to use a dirty bomb. But just to be clear, would the U.S. be forced to respond? And would there be consequences?
So just to be clear, and the president has said this many, many times, and he's been very clear about this, and he said it again today. It would be a major mistake for Russia to use nuclear weapons in Ukraine, leading to severe consequences. As for the potential use of a dirty bomb, to your question, Mary, look, Russia is pushing transparently false allegations. You heard me say that. You heard my colleague over at the State Department say that yesterday, that Ukraine is preparing to use a dirty bomb on its own territory. We are calling that false allegations by Russia. So we must take this seriously, which is what the president said today. You heard him say that, because in the past we have seen Russia use allegations as a pretext to escalate. And as the president said, we don't know if that is the case here. We don't see that to be the case. But again, we have not seen Russia make these preparations. You heard me say yesterday, you heard us say yesterday. But of course, we'll continue to monitor this very, very closely.
But if Russia does use a dirty bomb, will the U.S. respond?
We have been very clear through our private conversations with Russia about the consequences. I'm certainly not going to lay them out here. We have communicated directly with them. I'm just not going to get ahead of any conversations on what we laid out for Russians.
Saudi Arabia's energy minister said today that the mature guys or mature partner in this dispute between the United States and Saudi. Just wanted to see if the White House had a reaction to that.
So let me just say a couple of things at the top here. This is a relationship that was built, and I've said this also many times, over several decades on a bipartisan basis. So the president is going to strategically think through what the review process is and how we move forward with this relationship. He's going to take his time to consult with members of both parties, with partners, allies, and with the Saudis as well. We've taken note since the OPEC Plus cut that Saudi Arabia voted against Russia at the United Nations and also pledged $4 million to support Ukraine's reconstruction and humanitarian needs. These steps do not compensate, though, for the production cut, but they are noteworthy, and we'll be watching to see what Saudi Arabia does over the coming weeks, and we'll inform our consultations and review. I'm certainly not going to comment on any specific statements that you just said.
Seems like a little bit more conciliatory language, though, than you've been using for the last couple of
I
weeks.
think we've been very clear. We are noticing some actions that they've taken, as I just laid out, at the United Nations, and what Saudi Arabia was able to do in helping Ukraine, right? Because that is something that is incredibly important. That we see that from our allies and partners, in making sure that we support Ukraine in their fight for their own democracy and for their freedom. And so we always are going to lift that up because we know how important that is in this time, in this moment. Look, I'm not going to get into any tit for tat here from the podium about what someone may have said in Saudi Arabia, but I'm just going to lay out how this president sees this relationship and how this president sees this relationship moving forward.
There have been some assertions recently from Republicans and also from progressive lawmakers in a now withdrawn letter that the U.S. should be more actively involved in leading peace negotiations between Ukraine and Russia. What's the White House's response to that?
We've been very clear about that. That is up to Ukraine. That is up to the president, President Zelensky. There is nothing about Ukraine without Ukraine. We've been very clear about that. Our job, as we see it today, as we've seen it for this past year, more than a year, is to make sure that Ukraine has what it needs on the ground as we see this war happening in Ukraine. And that's why we've provided the security assistance that we have. That's why we provided the economic assistance and aid. And you'll continue to see that from us and from our allies. And so that is to make sure, and we're doing this to strengthen their hand, not just on the battlefield, but if they choose, if Ukraine chooses to negotiate. But again, that is up to President Zelensky, and he will make that decision for his country.
Thanks, Corinne. Following up on that, did anybody from the White House ask or advise members of the Congressional Progressive Caucus to rescind that letter as they did?
I don't have any comment to make about that letter. Again, we are very appreciative to the bipartisanship that we have seen from Congress these past 8-9 months, even over a year, on the funding that we've been able to provide, the bipartisan funding that we've been able to provide. And so, the president has been also very clear. He said this recently, our support to Ukraine is a lot bigger than just Ukraine. It's about supporting NATO and all of Europe.
Lying in the long grass, watching as the clouds pass, hands held in silence.
wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. I give up a love found, wish that I could write down what you mean to me.
Investment Status Quo by
Egypt is the center of the world, and the SE zone is the vital part that really connects.
Productivity. If you invest in productivity, we were hearing this before. If you invest in education and you create higher education, they're very clear indicators of what makes living standards rise. The first and foremost is you raise children, ideally in a family that has two parents who care about them, and that they go to school, a good school, and they get well educated, and they are civil, and they come out to a world of equal opportunity. And then enough, maybe enough resources that when they have great ideas, it's financed. And you have peace, you have prosperity. Those are the only things you need. So investing in those things is the way of the future. We're involved in philanthropy, and we see that you can make such big differences economically.
Is there a dollar shortage now, and is that the catalyst for central banks to blink?
It's going to be one of the catalysts. There is a dollar shortage, and the rise in interest rates in the United States is particularly dramatic for EM. They have a terms of trade shock, those that are importing commodities. They have a rise in interest rates because of what the Fed does, and they have their own domestic inflation, and then the weakening of the currency that increases the real value in local currency of their own debt. So for them, it is a perfect storm. Some of them have a lot of reserves. Some of them don't have reserves. Some of them receive IMF money. But there is right now a strengthening of the dollar that is implying even further tightening of financial conditions in the rest of the world. Now, I think that eventually the dollar is going to have to fall very sharply because we have a twin fiscal and current account deficits. In other advanced economies, you have a fiscal deficit, but you have a current account surplus. And now we're essentially using the dollar as a tool of national security and foreign policy. We're weaponizing it, rightly so. Sanctions against Russia, against Iran, North Korea, China. We're starting, by the way, a tech war with China, economic war.
What will be the catalyst for dollar weakness? How do we get there? Forget about this Plaza Court. It's
going to be essentially the Fed wimping out. Once you see a severe recession.
What does wimping out mean? That means blinking, right?
Yeah, blinking. They're going to blink and wimp out because you'll have a severe recession.
Wimp out, that's a new economic term.
It's a
mega threat to wimp out.
Well, either you're a hawk or you're a wimp, and so, or a dove in this case. But that's going to happen. And once the Fed is going to essentially prevent an economic and financial crisis, or try to prevent it by essentially stop raising rates, even inflation is too high, then the dollar is going to start sharply weaken. That's going to be the trigger for it. Because what's raising the dollar is, of course, the tight monetary policy.
We're sitting at a wood panel Davos-like bar, and there's a very famous Secretary of Treasury sitting somewhat near us, and you and I walked through the excesses of 05, 06, and you nailed 2008. Are we there again?
Yes, we're here again, but in addition to the economic, monetary, and financial risks, and there are new ones, now we're going towards stagflation, like we've never seen since the 70s. In the book, I point out that there are also geopolitical risks, like we're on a confrontation with some revisionist powers like China, Russia, Iran, or Korea that are challenging the geopolitical order of the US and the West, and that's going to lead potentially to conflict. There are environmental risks that are very severe. There are health risks coming from pandemics, and there is a relation between global climate change and pandemics. There are technological risks coming from AI, machine learning, robotic automation, destruction of jobs. There's a backlash against globalization, and we're going to go to a world that is deglobalized. There are political risks. We have polarization, and we have radical extremist party of the extreme right and extreme left coming to power, both in advanced economies and in emerging markets. And on top of it, we have amount of the debt like we've never seen before, explicit debt and implicit as well.
That's right where I want to go.
So it's a confluence of all these mega threats, 10 of them together.
Lipsky at IMF was heated about the debt buildup. On the back of your book, you've got a guy named Rogoff from Harvard, Bremer of Eurasia, Dr. Alarian from Cambridge, Martin Wolf, always wonderful at the FT. And at the very top, the quote of the season from Taleb, the gravities return to the physics. We've got a higher real yield now. We've got a risk-free rate now. What are the ramifications in our economic system that the gravities return to our physics?
Well, there were many insolvent agents in the economy because private and public debt as a share of GDP has gone from 200% to 350 globally between 2000 and today. In advanced economies, more like 420 and rising. In the US, it's now higher than after the Great Depression and after World War II, and we're not out of a Great Depression or a major war. And until now, even if you had zombie households, corporates, banks, shadow banks, governments, countries, they were built out. They were built out during the global financial crisis, zero policy rates, negative quantitative easing, credit easing, and even during the COVID crisis, many of them were fragile. They were built out again. We went back to do even more of the same. This time around, instead, is different because we have so much debt, and central banks like the Fed have to increase interest rates to fight inflation, so the zombie institutions are going to go bankrupt. That's why not only we're going to have inflation and stagflation, but we'll have a stagflationary debt crisis. In the 70s, we had negative supply shock, 73, 79, but we had very low debt ratios. So we didn't have a debt crisis in advanced economies. We had one in Latin America. Argentina, Mexico, Brazil borrowed too much in the 70s. When Volcker jacked up interest rates to 20%, they went bankrupt. After the GFC, we had the debt problem, mortgage debt, housing debt, bank debt, and we had the debt crisis, but it was a negative aggregate demand shock, and therefore we had low inflation and deflation. Today, we have the worst of the 70s with a massive amount of stagflationary negative supply shock. In the book, I identify 11 new ones over the medium term. And at the same time, we have debt ratio like we have never seen before. So we get stagflationary debt crisis.
Barclays is backing possible, unlocking possible, powering possible.
Period of high levels of private sector debt. And I could see it going both ways, because on the other one hand, I could imagine that in a heavily indebted economy, interest rate increases have a quick transmission mechanism, and that significantly impedes private sector activity and helps you fight inflation sooner. Or I could see it the other way, that high levels of private sector debt create a oversensitivity, maybe the debt crisis scenario that you're talking about. Walk through us specifically how it unfolds, the intersection in the US of higher rates and high levels of indebtedness.
In short, it becomes very ugly. And it becomes very ugly because the indebtedness of the private sector in the US was very high and rising even after the GFC, because we had zero rates, QE, credit easing, and so on. And then we doubled down on it during the COVID crisis. And of course, during the GFC was household debt and banks, but then the build-up in the next decade was of corporate debt and of shadow banks, leveraged loans, CLOs, high yield, high grade, fallen angels, and you name it. And while the debt of the household sector is now reduced, there are significant pockets of the household sector, those who have low income and low wealth and have borrowing, they're going to be under stress, especially as they get unemployed. So the biggest stress is going to be corporates and shadow banks, but eventually the official banks are linked to the shadow banks, and the household sector is going to also get in trouble. Those who have low income, they don't have much wealth, they have a lot of debt, and their income is fragile to a recession. So we'll have a debt crisis. So what's happening in this situation is that if you don't fight inflation, if you fight inflation, first of all, you have to jack up interest rates to the point in which there is a debt crisis, a recession, and then interest rates are so high that the zombie household, corporates, banks, shadow banks, government, countries that are insolvent are going to go bankrupt. And they were bailed out twice, during the GFC, during COVID. We had high debt ratios, but we had low debt servicing ratio because of zero rates on the short end, on the long end, and all the other policy of easing. Now, instead, into a recession, we have to raise rates because there is inflation. So those who were swimming naked as the tide recedes, you'll see where they were. Those who had the emperor without clothes, you'll see where they are. And the zombies are going to be recognized as zombies, are going to default. We're not going to be able to bail them out this time around. We'll have to raise rates and they're going to go bankrupt across the board. And I'm not saying everything and everybody in every country, but the amounts of debt, private, public, across advanced economy and emerging market implies a severe debt crisis. Now, interest rates for the public sector are going to rise. And in the UK, with stupid fiscal policy, those spreads widen in significant terms. But then the private sector has spreads over riskless rates, right? You have spreads over treasury, mortgages, high yield, high grade, consumer loan, and so on. So if you are an insolvent agent, it's not going to be just increasing long-term interest rates on treasury. It's going to increase your cost of servicing your debt, but the spread widening on your own private debt is going to cause another reason for default. And already high yield right now has gone from 300 to over 600. The entire CLO and leverage loan market right now is shut down, literally shut down. And this is only the beginning of it, of that stress on the private sector. So we're going to see significant financial distress in the corporate sector, in the shadow banks, in parts of the household sector.
So, I mean, you just laid out basically the stuff that you think could break first as interest rates rise. Where do you see other pockets of weakness? And I'm thinking specifically about some of the international developments, the impact of the stronger dollar. We've seen that weigh already on a number of emerging markets who have taken out dollar-denominated debt. That's getting a lot more expensive as rates go up and the dollar strengthens at the same time. Talk to us about the sort of international repercussions here.
Well, the international repercussions for emerging markets is that many, not all of them, of these emerging markets are in deep, deep trouble. I don't want to lump them together. There are better credits, worse credits, better sovereign, worse sovereigns. So you have about 40 countries, but I would say a good 2/3 of them are in trouble. And they're in trouble for several reasons. One, interest rates are rising in the US in advanced economies. So their interest rates and their spreads are rising even more. Two, their currencies are weakening as the dollar is strengthening. And unless you are a commodity exporter, mostly the guys in the Gulf who are making a fortune, everybody else among emerging markets tend to be, with few exceptions, a commodity importer, especially in Asia, but also in other parts of the world. And therefore you have also terms of trade shock. So it's a quadruple whammy. You have, first of all, the raise of interest rates in advanced economy, pushing your interest rates higher. You have the weakening of your currency, and you have a lot of dollar debt, and the real value goes higher. You have a negative terms of trade shock, and the slowdown of growth and the recession in US, in Europe, in UK, in China, effectively there'll be a recession, weakens your export markets and your own economic growth. So it's the perfect storm for the weakest emerging markets. And I would say a good 2/3 of these emerging markets right now have these types of economic and financial fragility. Now, if we're going to have a recession in the US, it's going to be even worse in Europe, in my view, for several reasons. Reason number one, Europe is more exposed to the Russian energy shock, and it's going to get worse, this war, and there'll be a total cutoff of natural gas. Secondly, the dollar is strong, and that reduces inflation. The euro is weak, that increases inflation. Inflation is already double-digit in the Eurozone, let alone in the UK. Three, Europe is exposed to export to China, and China is slowing down very, very, very sharply. And four, within the Eurozone, you have this fragmentation risk of the risk of a widening of spreads of the periphery. They have this new tool, TPI, but if the new Italian government follows policies that are on a collision course with Europe, they're not going to qualify for the bailout that the ECB is going to make for those that have unwarranted widening of their spreads, as opposed to those that are warranted by poor economic and fiscal policy. So things are going to be even worse in Europe than they are in the US. And the basket case, of course, is the UK right now, that is pricing literally like an emerging market. Usually you do fiscal stimulus in US, the dollar gets stronger, interest rates rise only little. In the UK, the pound is collapsing and the interest rates are through the roof, even with the support of the BOE. So
sales
it's
of
really
YouTube
becoming
seeing
an
a drop in
emerging
revenue
market.
for the quarter.
Is there
Overall, Google's revenue saw the slowest growth rate since 2013. A lot of focus here on the YouTube ad slowdown. That tone on the conference call from Google last night, I think mirroring what we heard on the ad market from Snap just a couple days ago when it reported its earnings. But for me, the biggest story here of tech this year, and coming, especially coming off a quarter like this, is the great Google belt tightening underway. To hear Sundar Pichai, the CEO of Google, hop in this current earnings call and say that they are reprioritizing investments, pulling back on projects, looking to grow headcount way slower in the fourth quarter is a huge story. I can't recall at a time outside the Great Recession when I've heard Google telling us they're going to slow down on hiring and cut back on projects.
Well, some of those other bets that the company continues to make is not going to pay off or be profitable for an extended period of time. And in some cases on the self-driving parts of the business that they've invested heavily in, you think about Waymo, that's not going to be profitable until you've got even more regulatory red tape that's cut. So in the meantime, it is, as you mentioned, that belt tightening that they're going to be doing and how the ads kind of sustain them between now and then for part of the business that is essentially 79% of their revenue base. It still comes down to advertising. And so when you do see only a 6% growth rate year over year, that is something that's alarming, and it really signals the pullback in spending among financial services, insurance, loan, and crypto segments that they've mentioned.
There was a refrain among the analyst commentary that sort of brought it home for me that Google is not immune, right? There was this thinking coming into this that because of its search business, that Alphabet's Google would be more resilient, more resistant, YouTube as well, to what's going on in broader technology, because it is not as exposed to what's going on with the Apple tracking changes among ads, because it has its own proprietary data from search, because of what goes on YouTube to some extent in the data it has there. And this quarter showed that's not necessarily the case. It does have some vulnerabilities to what is going on in the broader world.
And I'll say real quickly here, a lot of focus on operating margins. Brent Thill noting that operating margins for Google down 390 basis points quarter over quarter and 930 basis points year over year, which really speaks to the notion that they have to get these expenses under wraps. And if Google has to deal with this, best believe we're going to hear the same tone when Meta reports.
Absolutely. We're also keeping a close eye on Microsoft this morning here, as this is another tech giant that's got shares tumbling in pre-market despite beating on Wall Street expectations for the first quarter here. Slowdowns in the PC market. You got cloud services and a strong dollar all weighing on sales for the quarter here. And particularly you think about some of the cloud systems perhaps there. That came in line with the expectations of about $20.3 billion. And then they talked a lot about Azure on the call. But I think particularly within this as well, the FX, we've heard this cited especially from so many of the tech companies that have that multinational global presence. And FX is going to continue to impact this company. And it was in line with expectations for this most recent quarter, but they mentioned going forward from here, that is still something that's going to have a headwind in these coming quarters as well.
Yeah, I think John DiFucci over at Guggenheim, I think really nailed it in his notes, saying this, quote, "We see this as a generally weak macro environment having material effect on a broad-based, well-run company." So like Google, like Julie mentioned, there was this notion that coming into these quarters, these big giant tech companies would be able to withstand this economic slowdown, maybe not show growth falling off a cliff here, but this commentary from Microsoft on PC demand, a slowdown in Azure, all major red flags, and I would argue in the market just didn't anticipate hearing this tone. That's why you're seeing Microsoft shares, the top ticker on the Yahoo Finance platform, and of course losing a lot of ground here in the pre-market.
Yeah, and to be clear here, I just want to emphasize what you said. Growth is not falling off a cliff. Alphabet sales still accelerating. Microsoft Azure sales up 42% last quarter. If you back out currency, they're growing, according to what the company says, they should rise around 37% in the current quarter. So it's not that as though things are going, quote unquote, badly on an absolute basis. It's on a relative basis to what they've been doing and relative to street expectations. So growth is slowing, it is not stopping, it is not reversing. It is in some categories, as you can see there, but overall, for these large companies, it's not that they're doing badly, so to speak, it's that they're not doing as well as they were.
Right on, and the other problem is you just did not get the visibility, I think, from Google and Microsoft on when that growth rate will stabilize. So right now the market is reading these quarters as if, a couple more quarters from now, we'll still be dealing with a slowdown in Azure, in Google's ad business. None of these companies gave guidance saying, you know what, by the middle of next year, things should be a little bit stable, and we'll be back to re-accelerating growth in the back half of next year.
Right, and so for a business that touches so many different parts of either the consumer experience or the business experience as well, continuing to look across the portfolio of clients that they have. And Microsoft talked a lot about some of the overlaps that they see, even with another major ERP company, with SAP, on the earnings call. And Satya Nadella really giving a huge nod to how many of the offerings actually are just in synergy with what is already being run by so many of the companies. That actually gives them even more of an install base, as they call it, that they can sell into if you've got so much of, you could say, a competitor in the cloud, or at least in some of the collaboration tools. But if they've got another major player in the ERP landscape that they can sell into because of the ease of overlap or integration with what Microsoft offers on the cloud front as well, I think that's just another point that really speaks to that growth opportunity that's still there for them right now, too.
One more tiny point, last point. We talk a lot about currency. We talk less about energy costs. I don't immediately think of energy costs for big cap tech companies. And yet Microsoft is going to spend $800 million more this year to cover the higher costs of powering data centers, particularly in Europe. So this is something that is biting the large cap tech companies as well. Let's talk about Texas Instruments, the chip maker, also sliding in pre-market here. It's down 4.4%. After giving weak guidance for the current quarter. It did, like Microsoft, beat last quarter in terms of its earnings, citing slowing demand across the board, including the industrial sector. Texas Instruments went on to say the only place it is seeing strength is in car manufacturing. Remember, TI is a different kind of chip maker. It's an analog chip maker. It goes into a broad range of different kinds of products here, so can be a bit of an economic bellwether here. At the same time, the company saw a big increase in inventories, but its inventories are sort of more flexible, more nimble than some of the other chip makers we talked about, so they didn't flag that as a cause for alarm. Still, one really interesting thing that stuck out to me, the CFO saying it's impossible to say whether the current decline in demand is sort of an inventory correction or deeper concern about the economy. And that's really telling. The tone, to your point, Saz, about what we're hearing from companies is important.
Yeah, with Texas Instruments, I mean, I love to think about them as my own kind of anecdotal experience with the TI-83 Plus calculator growing up. But yeah, then you start to remember that this is a company that also has chips that can go into everything from how you're powering your in-vehicle experience, and from one kind of segment of the business to another that is looking for other opportunities to continue to grow out that demand within the chip segment that's seeing so much investment. I think this $3.3 billion that they've already invested into R&D over the past 12 months is extremely significant, and just revving up what that capacity could look like, how they continue to service an automotive landscape as well as other segments and sectors that are going to need some type of chip solution or semiconductor solution from Texas Instruments.
Yeah, I'm really looking forward to results out of some of these PC makers, Dell, you name it, because you had some, again, Microsoft week, Texas Instruments earnings call, no indication that there really is any improvement in the macro environment. I would argue they suggest that things are about to get worse, so that could be a whole bunch of ugly quarters from the PC makers.
Yeah, let's get a bigger view on what's going on in technology now and continue the conversation on the tech space and this morning's earnings with Independent Solutions Wealth Management Portfolio Manager Paul Meeks. Paul, good morning. It's good to see you. Are these companies, by and large, less resilient than you thought that they might be?
I actually expected them to get dinged by the macro, because one of the things that you have to remember, particularly with the social media oriented companies, their digital advertising models, and even if they have big slices of market share in that space, the pie is shrinking. And so when you take a look at Meta and Alphabet, I thought Alphabet, given the fact that it's not going through a wrenching business model change like Meta is, would be more resilient. But Rand, the results that even Alphabet reported last night did chill me a little bit.
Paul, you said in your notes to us that you're only investing in the dogs with the fewest fleas out there. So what do you mean by that, especially right now, given some of the macro headwinds that companies have continued to cite, especially within tech, over the course of this earnings period?
Yeah, so what I mean by that is, I'm best known to be a tech investor. People don't hire me to invest in Procter & Gamble. But of course, I'm not naive enough to know that my sector could be out of favor, and it could be out of favor for long stretches, and we're actually in one of those stretches. So I don't want to force feed anything. So my portfolios, I have very large cash. and I've been that way since Thanksgiving of last year. And when I say that dogs are the fewest fleas, I don't want to sound like I'm being cavalier, but I'm looking for companies that can actually grow their revenue and earnings despite a recession. When they report said numbers, they are beating the numbers, and they still have maybe not great valuations, but reasonable valuations. And quite often these are companies that are much smaller cap than the FANGs, that are under the radar, that I find at least some semblance of value.
Paul, you mentioned that the Alphabet report gave you chills. What do you need to be ultimately seeing over the next couple quarters to become unchilly? When do we see things getting better for Alphabet?
Yeah, I don't think that we can actually say with any confidence, I need to invest with confidence, that we have seen the last downgrade in quarterly revenue and earnings per share estimates for that company. And so regardless of the fact that it's, in some measures, at least according to its history, it's screamingly cheap, we cannot rally, or we cannot rally consistently until we get a bottom in the numbers. And I don't know if that's the next quarter. I don't know if that's the next quarter after that. So what I need to see is a bottom in the estimates, no more downgrades, and maybe, even if the company continues to report bad news, maybe a rally despite the bad news. Those would be two very good tells, not just to get back into Alphabet, but the other large cap tech names.
Paul, you've been through other tech cycles, right? How does this compare, do you think? How is it going to compare? And are we going to see fallout where we're going to see some companies go away, or maybe some of the smaller players get snapped up?
I actually think that some of the tech companies, or tech-ish companies, or tech-related companies that essentially were brought to the dance only because they were COVID plays may not have another growth leg post-COVID. And we're seeing a collapse in some of those. So I think some of those will actually go bust. But I've been around a long time, through lots of cycles, particularly when the internet bubble popped in the early part of this century. And back then we had a lot of companies that were actually fraudulent, where they didn't really have sustainable business models even on a good day. And so I don't expect to see the carnage in technology, anything this time, as bad as that was.
What's the new normalization for companies who have relied on PC demand for so long and are now seeing the long tail of PC start to wither here?
Yeah, that's the problem, because we did get a bit of a respite with big PC demand during COVID for the obvious reason, everybody going remote. But remember, the last couple of years before the pandemic, the PC market sucked, right? It is a 80s and 1990s technology. It was absolutely mature, not just in the States, but all around the world. And so it was growing very slowly, as actually declining. So unfortunately, post-COVID, I think we get back to that. And you don't want to be a company that is solely reliant on a reacceleration in PC demand, because I just don't see it, even when the economy comes back.
Paul, I want to ask you about one more company, and that's Meta. I believe one of the other times we talked to you, you said it was your least favorite among the large cap tech space. What do the earnings that we got late yesterday tell you about how Meta might do?
Yeah, it's going to be bad. But the problem with Meta, maybe the opportunity in Meta, is that the stock is so oversold. Maybe we're pleasantly surprised. We won't be pleasantly surprised by the fundamentals. They will be poor. But the stock is also reflecting a lot, right? Because it's so dramatically underperformed the rest of the group, even other digital advertising stories. But man, I would not buy that before the report tonight. Way too dicey. Stock could go down even further.
We shall see. Paul, always good to get some time with you, especially on a day like this when there's so many tech earnings to consider. Independent Wealth Solutions Management's Paul Meeks, thank you again.
Thank you.
Let's take another look at how some of these companies are faring in pre-market, and we got some extra ones on there for you too. Chipotle and Mattel, which have recently reported as well. Later on, we're going to speak to Chipotle CFO Jack Hartung and Mattel CEO Ynon Kreiss on the back of those earnings reports. Stay tuned. You don't want to miss those conversations.
The secret to every perfect move.
Wow, so cool! Won't it hurt?
Tiger Balm Plaster provides soothing relief with unique herbal formulation. Stretchable, and breathable for maximum comfort. Tiger Balm Plaster. Roar with lasting pain relief.
Welcome back. Shares of Spotify down about 6% after the company posted wider than expected losses for the third quarter. It did top revenue and subscriber growth expectations as the streaming giant reported 456 million monthly active users for the quarter. That's a 20% increase year over year. Yahoo Finance's Alexandra Canal joined us now to break down those numbers. Ali, what stands out to you from the Spotify quarter?
Well, Spotify, it seems to be the same story quarter after quarter, right? Margins are disappointing, but hey, we're going to keep spending and hope for the best. And that was the case this quarter as well. Spotify saying that its investments in projects and experience, as well as the product, have helped maintain significant user growth, but that's also been a big drag on margins. Those margin numbers coming in at 24.7%. That's roughly on par with the second quarter, but missing expectations of 25.2%. The company said that was largely due to the renewal of a large publishing contract outside of the US. It also added that profits were squeezed by slow advertising growth. And that's something that we've seen really across the sector, most recently with Alphabet reporting that slowing revenue for YouTube. And when we think about a recession, when we think about this embattled digital ad market, that's not good news. Looking toward the future, Spotify guided weaker than expected fourth quarter margins, and that contributed to the sell-off that we saw in after-hours trading last night. That seems to have continued this morning. The stock down about 6% in the pre-market, but it wasn't all doom and gloom. As you mentioned, Julie, we saw monthly active users beat expectations, a narrow beat on revenue, but wider than expected third quarter loss. And that, coupled with the margins, not great for investors.
So staying on those margins for a second, I mean, with margins continuing to disappoint, how does Spotify plan to kind of stop the bleeding here? And what are analysts saying about the report?
Well, right now, Spotify is really emphasizing that this is short-term pain. The CEO said on the earnings call that it's going to start to reverse in 2023, that drag on margins. And early this morning, we did get a lot of price adjustments on the street. JP Morgan, Barclays, Jefferies, they all lowered their price targets on the stock, citing that worsening ad environment, as well as foreign exchange pressures and the slowdown that we're seeing overall when it comes to ads moving forward. So it's very possible that we could see Spotify raise prices, considering they've been spending so much. We just saw price increases from Apple Music. We saw price increases from YouTube. Spotify saying that they have the pricing power to do this. So that's something to watch moving forward. But I will say, even though a lot of analysts cut their price targets, they are maintaining their hold ratings, their neutral ratings, their overweight performance on the stock. So maybe they do believe that this is short term.
Yeah, good point. Definitely on pricing. Daniel Ek, the founder and CEO, certainly, at least to me, highlighted that or teased that is likely coming potentially very soon. But you're also looking at some potential problems on the App Store for Spotify.
Yes, and this has been a long battle between Apple and Spotify. Apple has really welcomed a lot of regulatory scrutiny when it comes to its App Store policies. It maintains a significant amount of rules, a 30% revenue cut for in-app purchases. And this is what Spotify is trying to skirt around. Reportedly, according to the New York Times, Apple has rejected Spotify's app update 3 times in 1 month. Spotify trying to update its app so that users can purchase audiobooks. So that's something that CEO Daniel Ek tweeted about this morning. Elon Musk even weighed in, calling it concerning. Apple seems to have this monopoly, but it's something that we'll be monitoring moving forward.
Good work on Spotify. Y'all finds his Ali Canal. Good to see you.
Yes.
All right, earnings madness is in full swing. We'll have hot takes on numbers from Harley Davidson, Kraft Heinz, and others straight ahead. Welcome back. Let's get right back into earnings here. Boeing with a big miss in the third quarter. Shares of the jet manufacturer in focus, down a little bit following a much wider than expected loss for the quarter as the company was impacted by a fixed Price Defense Development Program. Looking at a letter obtained by Yahoo Finance from CEO David Calhoun to Boeing employees on the earnings, saying he's still referencing Boeing as a quote.
The thing that was more on the positive side was the free cash flow from the company, right? That we saw $2.9 billion for the third quarter, which was a lot better than estimated. And when you're talking about a company like this, the liquidity, the cash position are important. So the stock is down. This might be why it's not down further, was the sort of, well, at least the free cash flow is better than estimated.
Because I'm not used to saying the positive with Boeing, Julie. Sunny Julie here with the positive.
I just like to highlight the opposite of whatever you guys
I know you do.
have.
I know, it's so very true. Clearly, we were very negative, clearly.
Yeah, so that's the one thing. I think it's, it's okay to highlight the other things.
You can't find anything good in those Google and Microsoft reports. I mean, come on, they were great. I knew they grew, Julie. I know we saw sales grow, et cetera, but come on, I mean, those aren't good reports.
There was part of it that wasn't that bad. But I mean, as we sort of march toward the opening bell this morning, I mean, obviously, the fact that we have seen the NASDAQ rallying in advance of these earnings tells us something about the expectations game, right? And that there was this expectation that somehow these guys would pull it out and do better than estimated. So the fact that they have not, is more reflected in these stock prices and the declines that we're seeing than they otherwise might.
It also might be investors thinking to themselves, what more could possibly happen at this point? If you're already pricing in the FX headwinds that all of the companies are talking about, if you're already pricing in a consumer that may not be cozying up to some of the consumer technology that you're purchasing, and if you're already pricing in a severe slowdown in ad spends, then for investors, they may look at this and say, okay, is everything fully priced in at this point? And now it's just kind of a wait and see effort to understand fully where that ad spend continues to pull back, where discretionary dollars may tighten up even further from here, and on what spectrums of the affluent income consumer or a low income consumer. And so with all of those things considered, there's a lot to still know about it, but there's been so much of the consideration that's already been kind of levied towards the share prices here.
Yeah, I'm surprised. Last night, listening to those earnings calls from Alphabet and Microsoft, I thought futures would have been down 300-400 points. But the fact that they're not might be pretty telling.
Maybe because things weren't even worse.
I mean, Alphabet said they're essentially really almost done hiring. It's just, I haven't heard that tone before. Microsoft, barely grew in some areas of its business, signaling a major PC slowdown. This is big stuff.
But we knew about the major PC slowdown, right?
It's tough to see it.
Yeah, I don't know. I'm struggling a little bit with this too. But yeah, we got obviously a sharply lower open that we're setting up for, particularly with the NASDAQ here because of all of these tech heavyweights reporting and disappointing. You got there another heavyweight of a different kind ringing the opening bell this morning, 3M, with the opening bell. But again, it is interesting here as we try to kind of make sense of this, like just how bad are things. Yes, we have these companies that are not hiring anymore, but they've been hiring for years, like a lot of people. So
I wonder if you work at Google. Maybe don't get your free food. I know it's very important. You have to have your free food at Google from various outfits from around the world. You need your free food.
The free food is still. I don't think the free food's going anywhere.
Big expense. Big expense.
If they're but also people aren't at the office anyway. I don't know.
Don't take away my free food.
Brad, help us here. Help us here. We need some free food. We need some interactive action.
Everybody, if you're coming back into the office, everybody's kind of channeling or paraphrasing Fetty Wap. Throw that free food my way.
Wow.
All right. Well, here we are out of the gate here, the Dow Jones Industrial Average. Right now, we're seeing the flat just barely to the upside here by about 8-9 points, we'll call it, over the past 2 days, still holding on to gains. We've got a little bit of hyper oscillation out of the gate here, so we'll keep a close eye on that. Additionally, the NASDAQ composite right now, you're actually seeing that down by about 240 points. I'll dig into tech in a moment, but right now it's down by a little more than 2% for the tech-heavy average. The S&P 500, you're also seeing that to the downside by about 0.9%. So let's dig into the sectors to see where some of the most declines are coming in from at this point in time. Early in today's trading session, just about 90 seconds in here, you've got more advancers than laggards here, but there you're clearly seeing technology, that is one of the major laggards here on the day off the back of some of those earnings reports from mega cap tech. 2.5% lower for XLK. You've also got communication services that is down by about 2.7% right now. And then just taking a quick look at the NASDAQ 100 heat map where many of those tech components lie. You're taking a look here at Microsoft. Microsoft is down by about 7.8%. Additionally, they're taking a look at Google, Alphabet, whatever you want to call them lower by 8.7% right now.
Yeah, and I'm looking at TXN over your shoulder there, down 4% also, so definitely. But not as much red as that overall on that NASDAQ 100 heat map as I might have anticipated, which is also interesting here. Obviously, not everything on there is tech. You got Pepsi up, for example, but still, halvesies, about halvesies.
Yeah,
interesting there. Yeah. All right, let's talk about another stock that we are watching, and that is Harley Davidson. Those shares on the move higher as well this morning, up 8%. After earnings beat on the top and bottom lines, the motorcycle maker posting a revenue increase of 21%, delivered over 57,000 bikes across the world in the third quarter. That deliveries number is up 19% from a year earlier. And of course, we had the spin-off of the electric bike division of Harley as well, which has been a money-losing division. So the refocus here on the traditional business. I know you watch Hog closely.
Yeah, there really is, I think, a budding turnaround under CEO Jochen Zeitz that I don't think a lot of folks are talking enough about. I know he's transformed the campus over at Harley Davidson, restructured a lot of the operations, and it appears all the efforts that he undertook last year that impacted results in a negative way now seem to be benefiting results in a positive way, or at least for the second half of this year. Very important to see a manufacturer like Harley Davidson end this quarter with almost $2 billion in cash. You know, if it's a very important metric for Boeing, like you mentioned, Julie, it certainly is very important for a company like Harley that's ramping up its product innovation alongside an economic slowdown around the world.
And it's really interesting here with the global motorcycle shipments that they actually saw grow 19% in Q3 versus last year. And they're saying that they've largely recovered from the previously announced unexpected production suspension in Q2. And so this considered, you're looking at a brand still that is a premium product in motorcycles and even in vehicles. If you're just looking to get around, this is still a very pricey product. And for Harley, the challenge is when you've got a vehicle or a motorcycle that is as expensive as it is, trying to cozy up to that new age consumer as well that might not have that type of expenditure or that type of disposable income to put or throw down on a motorcycle or even finance it over an extended period of time too. So I think it's really coming down to what that pricing mechanism will be in the near future, and then also what this ownership, about 84% ownership that they have continued of Livewire, what that continues to do for them as an investment at this point in looking at the next wave of electric vehicle or electric motorcycle adoption too.
Where's your bike stored? You have it away for the winter?
You know, mine is actually in our bike rack just right in the apartment.
Bike rack.
Yeah, that's exactly where my bike is. We're also watching shares of the Kraft Heinz company here on the day. Ticker symbol KHC. Those shares this morning, we're actually seeing those hold on to some gains by about 1.25%. Company top earnings estimates for the third quarter beating out expectations on both the top and bottom lines as net sales grew nearly 3% year over year for Kraft Heinz. All right, so one of the good pantry names here for Kraft Heinz. I mean, it is.
Yeah, no, I was looking at this corner. I was reminded, I just had a flashback to all the American cheese and packages that I ate as a kid. This was almost a by the hour snack for me, like 2 pieces of American cheese, you fold it up and eat it, but it was just, I don't know, whatever. But anyway, Kraft Heinz, another good turnaround story, starting to gain a lot of traction under CEO Miguel Patricio, and another food company, like we've been highlighting the past 2 weeks, pushing through some serious price increases, double-digit price increases benefiting their sales. Volume did take a hit, but still, wow, double-digit price increases, not unlike we heard from Coca-Cola yesterday, pushing through 12% price increases in the U.S.
Even with everything that has happened, have we heard a company say, no, we've not been able to raise prices? I can't think of a single company.
Well, they don't come out and say it, Julie.
No,
but
of course
what
not.
they say is Chipotle. Look at Chipotle when they went to reported last night. They said lower income consumers are visiting their stores cheaper. So they once said people are balking.
Yes.
That's how you see it though.
But what we've been seeing in profit report after profit report is that they are benefiting from these higher prices. In other words, even if consumers are pushing back to some extent, it's not enough to outweigh the profit gains in most of the cases that we've heard about thus far.
Well, where do you go?
Remarkable.
In this environment, if you're, let's say, a P&G and you have Tide, Well, now the private label stuff is almost on par with some of the prices of Tide. So where do you can't hide out anywhere.
And I think the consumer is thinking the same thing. If I can't really hide out anywhere and I'm going to be taking on prices wherever I turn, then why not just continue to lean to the product that I've purchased for years, if not decades at this point? And so there is kind of that brand affinity that consumers will still display, continue to take price, and even in some parts of their retail experience, they might just go buy and hold on products too, thinking that they might not be able to come across that inventory later on.
I used my first Tide Pod last week. It was pretty cool. Like, they feel kind of fun, and you just throw it in there. It was, I don't know, it was a fun moment for me. I never used them before.
I don't think I've ever used a Tide Pod.
Yeah, it's pretty cool.
Nope.
Try it out.
I know you're not a Tide Pod. You're not a Tide Pod. Yeah. No?
I mean, this is a really hard motion to do. All right, coming up, Hilton is lifting its forecast after its profit beat expectations. Saz is going to share his top takeaways from that earnings report next. Hilton raising its forecast after beating estimates for the third quarter, boosted by higher demand for travel. The company saw its average revenue per room top 2019 levels for the first time since the pandemic began. Travel and leisure space is where we find Sazi's take today.
Yeah, this is where I am in an effort to get or touch more tickers on these crazy earnings days. My take is about Hilton. So I went through the quarter, get some things I liked and what I didn't like. Let's start with things I liked on these Hilton results. First up, operating and net profits above the high end of Hilton's guidance, checked on. Good thing indeed. Earnings beat estimates, checked on. Certainly like that. RevPAR exceeded the third quarter of 2019 levels. RevPAR, key industry metric for the hotel industry, stands for revenue per available room. Gives you a good sense on demand, but also the price increases that a Hilton is or could be trying to push through. Next up, share repurchases. Hilton started to become more aggressive in its share repurchases in the second quarter. They continue to be aggressive here in the third quarter. That is a good thing. Also, occupancy up in all countries, which I'm a little surprised about, given we've seen challenges, of course, in China. Europe is, in many respects, in a recession, but occupancy up in all areas of Hilton's business around the world. A couple things I didn't like. Cautious EPS guidance for the holiday quarter. Holiday, of course, The holiday season, of course, a big travel season. I think it's that cautious guidance, a little bit below consensus in terms of EPS. That's why the stock is not popping, I think, on these results. Also, RevPAR, again, revenue per available room, growth slowdown seen for the holiday quarter versus the third quarter. Now, RevPAR is still seen up 19% to 23% in the fourth quarter, but a little bit of a tick down in growth rate.
Well, that's good news for us.
That's good, might be good news for
people who want to go away and stay in
our
rooms.
shoppers. Indeed, Julie, that's an astute observation. It's good to have you back here today. Now, we just talked to Hilton CEO Chris Nassetta about just the overall demand backdrop in leisure. This was at our All Market Summit. Take a listen.
We've seen very, very steady recovery. So I would say we're at the beginning of what I think is going to be a new golden age of travel.
Oh, that's quite a headline. Golden age of travel, according to Chris Nassetta. I liked it, but again, investors not necessarily liking that guidance out of Hilton this morning. My take, fascinating to see investors ignore a comeback quarter for travel companies. If you go into Yahoo Finance and do wow, that's one thing I don't do is sleep. But anyway, if you pull up a comparison chart on Yahoo Finance of Hilton, Marriott, a lot of these travel companies, Expedia, the airlines, a lot of these companies reported good quarters, and the stocks have gone nowhere. It's as if the market is just bracing for this major slowdown and a recession this year, and they're just so focused on what may or may not happen next year.
Yeah, the demand in that golden age of travel is what all of the companies, whether it's airlines, whether it is a stay or accommodation brand like a Hilton, what all of them have discussed. And I think particularly it's the investment in adding on to their capacity that they've also talked about. That's going to be a considerable type of investment that they have to make back into their own operations too, whether it's airlines adding on more route capacity or even more planes in the future too, or if it's a company like Hilton, they've got 416,000 rooms that they're trying to bring online too.
Yeah, look, I think this quarter from Hilton ultimately suggests that we'll get some good results in a Marriott when they report in a couple days as well, maybe even an Airbnb, but it'll be interesting to see if these results start to get embraced by the market.
Yeah, we shall see.
All right, Chipotle is out with an earnings beat, but also with a warning about store traffic. We'll dig into the results with Chipotle CFO Jack Hartung next. Chipotle is out with an earnings beat as its higher income clientele was able to absorb higher prices for burritos and burrito bowls. The company did warn on two fronts: store traffic and spending trends among lower income consumers. Chipotle CFO Jack Hartung joins us now to discuss. Jack, always nice to see you. On the conference call last night, I thought you guys were defending the price increases that you've pushed through, noting the big portion sizes and what you do in terms of cutting ingredients. Do you think, or are you just concerned about some of the price points on some of the products now?
No, Brian, we watch this very, very closely. And, when we've raised prices over the last couple of years, and let's face it, it's been a high inflationary period. It's been the highest inflation I've seen in my entire career. When we take prices, we've looked at a number of things. We look at what our competitors are charging. We look at, what happened the last time we took a price increase, and are we seeing any evidence that customers are either trading down or if they're reducing their transactions. And everything we see looks good. I know this is an environment where we have macro challenges. We talked about on the call that we do have some of our lower income consumers, are paring back on their dining out experiences, including at Chipotle, but our, higher income customers are actually coming more often. So we're not seeing any kind of change in their behavior based on any of the pricing action that we've taken over the last year and a half.
Jack, you know me, I go to Chipotle all the time, but are you concerned that, a portion of the U.S. is just getting shut out of that really good Chipotle experience, and that now maybe you need to touch that third rail and do a value meal, or maybe cut the bowl in half and do a $5 bowl to get consumers in?
Yeah, Brian, we had this exact discussion the last time during the Great Recession, where we saw consumers did start to, reduce their dining experiences. And with Chipotle, during that time, even though our comps held up better than every other restaurant company, we stayed positive throughout that entire time, our transactions were actually slightly negative. So we did see some transactions actually dip. As the recession was starting to end, our transactions came roaring back, and we had double-digit comps from there. So we've seen this before, and during that time, we did talk about, should we offer value meals? Should we offer a bundled meal where the consumers can eat for, at the time it was less than $5. Our customers said, great idea, go ahead and do it. And then when we tested it in restaurants, nobody bought it, because everyone said, well, I love my chicken burrito, so I'm coming for my chicken burrito or my steak burrito. So we don't think Chipotle is the brand that somebody's looking for a dollar menu or a bundled meal. They come to look for customization, real culinary, and they crave the food. That most customers get the same exact entree every single time, and that's what they crave. And so, and when we look at our chicken burrito, which is what more than half of our customers get compared to competitors, we're under $9 for our chicken burrito. And when you get a chicken entree at other fast casuals, you can't find any for under $10, and typically it's in that $11 to $13 range. So we still think we're a great value.
Jack, what about the people that come to Chipotle for lunch particularly? And when it relates to that traffic, how you're looking through where some of the office occupancy that still isn't at pre-pandemic levels and is still, in some cases, data from Castle suggesting it's lower than 50% of that pre-pandemic level and really only expected to tick up sometime in 2023. What would you be tracking with regard to the relation of return to work or return to office and how that plays out for Chipotle going into next year?
Yeah, when we look at our urban restaurants, and the urban restaurants are a relative minority of our entire portfolio of over 3,000 restaurants. So we've got somewhere in the 100 to 150 restaurants that are true urban. When we look at that cohort compared to all other restaurants, they've been out comping the rest of the system for the last year or year and a half or so. And that makes sense based on people are returning to the office. Now, it's not all the way back, but I would say it's within kind of 10 or 15% in terms of where the urban restaurants are compared to non-urban. So it's not all the way back, but it's not like it's anywhere near, you mentioned the 50% occupancy. We're doing way better than that.
Hey, Jack, it's Julie here. So transactions down by about 1% last quarter. Do you have any sense of what that number could be this quarter? And I guess I'm trying to get a feel for where you think we are in the cycle. We're all grappling this morning, looking at big tech earnings, about how much worse things could get. From your perspective, how are you thinking about that question?
Yeah, we have a unique challenge in the fourth quarter because we introduced as a limited time offer brisket last year in the fourth quarter, and it was highly, highly successful. So we're comparing against that very, very difficult comparison. So contributing to the quarter is it's going to be a little bit more negative transactions. We think it's going to move from the 1% down that you mentioned in the third quarter to somewhere in the low to maybe the mid-single digit, transaction being down in the fourth quarter. But as we move away, brisket, we actually could only secure enough supply to run the promotion through the middle of November. That's how successful it was. Once we get past that, we think that the comparisons will get a little bit easier. But we do think from a macro standpoint that the lower end consumers are dining out less often. So we do think that that's going to be a challenge for not just Chipotle, but I think the restaurant industry for probably the next, few, if not several quarters.
Jack, I don't know if you can see it, but my Yahoo Finance team never ceases to amaze me. We have some of the photos. There I am right there. About a week ago in the Bayshore Chipotle, I got my usual order. That is all for me. 2 bowls right there. I ordered the same. I ordered the same thing last night. I went to pick it up, $48.23. Now I get double meat, and I understand. But do you think you could
see some guac on there too?
Yeah, there's a lot going on there, and I get it. But do you think you could push through more price? I'm still shopping in there. I'm still going to Chipotle, but do you still have more room to push through more price increase in the fourth quarter next year, you think?
So I think we do, Brian. Listen, not many people eat like you do. I think it's a tribute to, I don't know if it's your exercise routine, but the fact that you can eat 2 bowls like that and you look as good as you do, I think it's
Appreciate
fantastic.
you. That's why we always have you on.
But listen, I do think we have room, but we don't have any plans right now to raise prices again. It depends on commodities. But what I do know is that when we look at competitors, others have raised prices too over the last couple of years. So the gap in terms of value for Chipotle compared to the others still exists. But right now, if commodities behave themselves, we don't have any plans to take any more price for a while.
Okay, and so in the near term then, because you've still got the affluent consumers or the people that are ordering double guac, double meat, like Brian, who are coming in. When you think about the ticket sizes that you're seeing, is there it is, zoomed in. Is there a material difference in ticket size, even among the outsized affluent consumer that you're seeing make up the majority of the revenues right now?
It's not huge. There is like a mid-single digit difference. It's a slight difference. Really, the difference is, and this is what tells us it's more about a macro. It's not that people are resisting. When we raise prices, it's 4% on an $8 or $9 burrito. It's 30, 40 cents. So we don't think that consumers are affected by that 30 or 40 cents. We think consumers are deciding, can I eat out at all? Or if I'm going to eat out, do I have to, maybe go down to another class, to traditional QSR, because it's just a different category for them.
Jack, good to see you. Chipotle CFO Jack Hartung talking us through the quarter and what's beyond. Thanks so much.
Thank you, guys.
Well, coming up, political debates across the country continue with midterm elections around the corner. Rick Newman is going to share the details next. The midterm election is only weeks away, and last night included some heated debates in both Pennsylvania and New York. Democrat John Fetterman and Republican Mehmet Oz clashed during a testy Pennsylvania Senate debate last night. The two disagreed over many issues, including the economy and abortion. Yahoo Finance's Rick Newman joins us now with some of the takeaways. This is one of the, I think, one of the most watched races, right, around the country. What was your impression of the debate last night?
One of the most watched races for two reasons. Number one, it could determine who controls the Senate, Republicans or Democrats, and also because of John Fetterman's health. He had a stroke earlier this year, and I think a lot of people who watched last night just wanted to know how was he going to do. So mixed reviews on that. I watched it. I thought he held up pretty well, and I know how draining an experience like that can be for somebody recovering from a stroke, but the reviews were pretty weak. He did stumble over words. He got some things wrong. Some of his responses just were not very well developed. But on the other hand, he was somewhat coherent. So the real question is, could this guy do the job if he gets elected to the Senate? And one of the most interesting things about this race, Julie, is going to be how much does his health actually factor in? Will voters in Pennsylvania, will they be inclined to vote against him because of health concerns, or will they say, no, they don't really worry about that? So quite interesting. And as you mentioned, they did clash on the issues over abortion and fracking and some things like that. So very interesting race in Pennsylvania.
Yeah, only one of them actually lives in Pennsylvania as well, so that perhaps is worth noting. Rick, additionally here, we know you're following the races in New York. What was taking place there on the debates?
Well, that was the governor's race between Kathy Hochul, the incumbent, and Lee Zeldin, the Republican congressman who's challenging her. You would think Hochul is a lock in this race, but this has also been tightening. Again, abortion was one of the big topics last night. So if Zeldin is able to win and become a Republican governor of New York, that would be an upset for sure. And if we were to see that, I mean, that would be indicative of a complete wipeout for Democrats. There is some new, there are some new forecasts suggesting that the Democrats are going to do better in the House than expected. The Cook Political Report, which is one of the top forecasters, now saying they could pick up something like 25 seats or more in the House. That's up from their forecast, their prior forecast. So at the last minute here, things seem to be breaking in favor of Republicans.
Yahoo Finance's own Rick Newman. Rick, thanks so much for breaking this all down, keeping an eye on the political spectrum. Coming up, everyone, on the other side of this short break, shares of Alphabet. They are lower by a little more than 7% right now. After YouTube revenue took a hit in the third quarter, RBC Capital's Brad Erickson joins us next to discuss. Peak Brad.
Welcome back to Yahoo Finance. I'm Brian Sazzi here with Julie Hyman and Brad Smith. Mixed action in the markets on this Wednesday morning on the back of weakish earnings reports from tech giants Google and Microsoft. At least right now, we're seeing the Dow up about 91 points, the S&P 500, NASDAQ slightly in the red. Here's what we have on tap for you this hour. The Google pullback. RBC's Brad Erickson stops by for a take on Google's less than stunning quarter and outlook. And maybe not so playful holidays. Mattel serves up a mixed outlook due to the economic slowdown. We'll chat shortly with Mattel CEO Ynon Kreiz. And the newest meme stock leader, Bed Bath & Beyond, gets a new CEO? Sort of. We'll have the details. But first, over to Inez Ferre at the Wi-Fi Interactive. Inez.
Yeah, Brian, and we're taking a look at new home sales for the month of September because we just got that data that came in. New home sales fell 10.9% to 603,000. That's an annualized rate. Now, that did come in, though, higher than the expected, that what economists had been expecting. Remember that in August, we saw a surprise to the upside for new home sales. September, though, was a month where you had the mortgage rates rising by more than 100 basis points. So that is expected to impact the slowing housing market. And why do we talk so much about the housing market? Well, because as housing goes, so does the economy. There are many jobs that are linked to the housing market. There are durable goods that are linked to this. Let's take a look at XHB. That is down 0.3%, but it had been down, the home builder ETF, more than 1% before this data came out. But I just want to point out the year-to-date chart here. You can see the losses for the home improvement and home builders. Taking a look at where we're at with the sectors, we are seeing technology that is lower right now. We're also taking a look at consumer discretionary that's lower. And this has to do with big tech, which has been reporting earnings, started reporting earnings yesterday with Microsoft and Google, both down more than 7%. You've got Meta, which will be reporting, that's down 3%. And you've got Amazon down 4%, guys.
Yahoo Finance's own Inez Ferre over there at the Wi-Fi Interactive. Thanks so much for tracking all that, Inez. Appreciate it. And everyone, getting to some of those tech earnings that Inez was mentioning, let's kick it off with Alphabet here, missing Wall Street estimates for the third quarter as slow revenue growth and a dip in YouTube advertising weighed on the search giant. But with its scale and diversified tech portfolio, is it positioned to weather disruption in the digital ad space? Joining us now to discuss and weigh in, we've got RBC Capital Markets Internet Equity Analyst Brad Erickson. Pleasure to welcome another Brad into the chat here. So Brad, first and foremost, your takeaways from Alphabet here, especially considering some of the different parts of the business. I mean, this is still 79% an advertising-based business here.
Yeah, that's right, and I'll do my best. Brian, I gotta tell you, I'm still reeling from how on earth you spent $48 at Chipotle, but let's talk Google, since that's what I'm here for. Yeah, it was a tough quarter all around. They missed top and bottom line relative to the street, and then I think the Q4 commentary was particularly ominous. They spoke to seeing basically a broader pullback in ad spending within that business, and then surprisingly, there's no layoffs at Google. Apparently, they're actually adding employees half the rate that they have been, so it's a little bit slower. But I think that caught people by surprise as well. And so you're seeing earnings estimates in particular come down enormously here this morning, and obviously reflecting that in the stock.
I want to ask about YouTube in particular. Is there something that Google can be doing, Alphabet can be doing with YouTube that it's not doing? Or is it just sort of subject to competition from TikTok, for example, plus the macro environment? And are there more levers it can pull there?
Yeah, I mean, I think there's a couple of drivers, right? First and foremost, YouTube, because it is a social platform and does rely on third-party measurement through IDFA, right? It was exposed to the Apple downturn, so there's absolutely been headwinds there. And I think, you know, they've somewhat abated from a year-over-year perspective, meaning we've lapped them. But I think there's probably still a bit of leakage going on there. And then, sure, competitively, we all know TikTok over the last year or two has sucked a lot of the oxygen out of the room for those in the social space. And so, you know, one of the comments management made last night on the call was someone asked about whether the mix shift they were seeing, the short form video, the YouTube Shorts, increased usage, if that was incremental to YouTube or if it was a mix shift, and they kind of insinuated that it was a mix shift. And so that's your sort of evidence that TikTok is continuing to have an effect on that business. Going forward, Performance Max is their product, which basically, if you don't know where to spend, be it search or YouTube or elsewhere, Performance Max is an AI tool that allocates your spend automatically. We do think that's going to be super important as they start layering spend into YouTube Shorts, YouTube ad spend, monetization in YouTube Shorts, but that's still early days, and so that's probably not going to show up in the numbers till next year.
Brad, how severe do you think these cost cuts will be at Alphabet?
Well, to date, I mean, like I said earlier, we're not really seeing evidence, at least directionally, of cost cuts, right? Like they said, they're gonna, from a net ad perspective for headcount, they're going to cut that in half, but that means they're still adding roughly 7,000 employees quarter over quarter, which is a lot of heads. I think as we get through to next year, the CEO kind of reiterates some other comments previously around trying to squeeze out more efficiency on a per head count basis. So clearly they're pointing to more cost efficiencies there. But yeah, I think people are a little concerned that hey, these guys are seeing a downturn. They're speaking to it qualitatively here going forward, and that's not being reflected in the cost base. Now, flip that, maybe let's just take devil's advocate for a second and say that's positive. It could reinforce the view that maybe Google is just viewing this as a temporary, transitory type of thing. A lot of confidence in the business longer term, and they don't need to go there. So you could argue it both ways, but certainly for today and where margin estimates are going, it's a negative.
And on the hardware side, it doesn't seem like they could even afford to lose out on an install base that they would see come in from the number of phone devices or smartphone or handheld devices, even with a waning PC market, even with some of the slowdowns in ad. It seems like they would need to continue to produce regardless of what the margins would look like on that side of the business.
Yeah, I mean, hardware is obviously a tertiary part of this model, but it certainly popped up, or flared up, I should say, a little more in the quarter, with the launch of the Pixel 6a. Obviously, that has a normal cost of bill of materials and gross margin profile for a hardware product, which is substantially below the ad revenues. And so that weighed on the model to some degree in the quarter. But, I don't expect that to be sort of a sustained headwind as we move forward here. So,
RBC Capital Partners Internet Equity Analyst Brad Erickson, good to see you. We'll talk to you soon.
You as well. Thanks.
All right, before we head to break, we have to check on shares of Bed Bath & Beyond after the company announced Sue Gove will assume the role of CEO after serving as interim CEO for 4 months. This comes in the middle of an attempted turnaround of the brand following several quarters of slipping sales and really a very long period of operating losses. You see the stock down slightly today, about 3%. Intel's Mobileye spinoff gets a disappointing IPO valuation. Julie's back with today's top headlines next.
Let's get down to business now. Look at some of the other headlines that we are watching. Intel is set to debut its self-driving unit Mobileye at $21 a share during its anticipated IPO. This according to the Wall Street Journal. That price represents a premium from its expected range. The unit, which focuses on driver assisting and self-driving technologies like sensors and microchips, comes both as driving aids become increasingly critical to portfolios of automakers and as the market for public debuts continues facing a dry spell. I should say it's above the range that was reported as originally being below the initial range. So I guess it's somewhere in the middle. The shakeup continues at Warner Brothers Discovery, the media empire announcing that James Gunn and Peter Safran will be the new co-heads of DC Comics, which oversees iconic properties like the Batman and Justice League franchises. This after reports that the company had taken a write-off of up to $4.3 billion on canceling projects like CNN Plus and Batgirl, as well as layoffs across the WBD company. And an Apple executive has confirmed for the first time that the company will comply with the EU's mandate for mobile devices to use USB-C. This during a tech event. The EU standard was enacted to help consumers simplify charging and cut down on e-waste. Apple's senior vice president of marketing didn't give away any more details on the commitment. It said the company would have approached the problem differently. The company had previously remained mum about whether it would honor EU regulations over the charging standard. Apple first introduced a Lightning port in its iPhone 5. It's not officially hinted at what might replace that port. Sauce?
All right, let's check back in now on the broader markets as the Fed juggles the balancing act of curbing inflation and averting a recession. Where does that leave investors seeking to balance the two risks? For more on this, we have BlackRock's Tony Desperito. Tony, good to always get some time with you. I think let's start on today's market action because I think what we're seeing is pretty interesting. Julie highlighted earlier in the show some pretty not good quarters from Microsoft and Google, yet stocks are hanging in there. Are we watching the bottoming process in markets take place?
Yeah, so I think, look, there's some short-term and long-term drivers here. And certainly if you kind of look year to date, the market has gone down dramatically, and all of it has been multiple contraction, right? We've gone from a multiple that was 22 at the beginning of the year to about 16, 17 today. Meanwhile, earnings have mostly picked up, although they're starting to roll over. And the market's dealing with the risk of a recession. So from my perspective, I like the valuation. I think the valuations have come back down to the normal range. I'm still concerned about earnings, and that's what we're seeing is a bumpy ride with respect to earnings. And I see more volatility in the short run because if you think about the Fed just started hiking in March of this year, 7 months ago, and that was a 25 basis point hike, by the way. And when you think about Fed interaction with the economy, those rate hikes typically take at least 6 months to have any impact, and the full impacts felt more like 18 months down the road. So we still haven't felt the full impacts of those rate increases. That's going to impact economics. That's going to impact earnings. And so I still see some bumpy ride ahead. And I think what investors should do is prepare their portfolios to be more resilient.
All right, so within that bumpy ride, who is sitting on the wheel or who's sitting in perhaps the most insulated part of the bus as we're continuing to watch the Fed and for their mandate, them trying to meet some of those benchmark expectations? For some sectors, they're going to experience this a little bit harder than others as we've seen both pullbacks in consumer discretionary, real estate's been hit hard, and then additionally, you mentioned tech a moment ago.
Yeah, so I think an active manager can really add value here, both through industry sector as well as stock selection. And I kind of look at the world in terms of cyclicals and more stable earners. And I think there's value to be added on both sides. In terms of cyclicals, in the fund I run, we're really favoring energy and financials as they both benefit from the inflationary impulse. Certainly energy, that's a long history there. And then on financials, you have the benefit of rising short-term rates, expanding net interest margin. And then on the more stable side, I'm really in favor of healthcare. Healthcare is certainly as stable as utilities and staples historically from an earnings perspective, yet has a better long-term growth dynamic, and the valuations today are significantly more compelling. And so that's how I see the opportunity to add value for investors.
What about a place like technology? I mean, if you talk about stable earnings, I mean, even though it's slowing earnings growth from many of the companies that we heard from late yesterday, it's still relatively stable. So I wonder how you're thinking about that group.
So I do think that there are real pockets of technology where there's real good opportunity. And I'd even put it in that stable bucket, kind of a new staple, if you will, in that just because there's a recession, it doesn't mean you can slow down on your tech spend, right? And so we're still seeing cloud grow. It's growing a little bit more slowly than maybe it has historically, but it's still growing by leaps and bounds, 40% plus in the quarter as we look at recent reports. And so I do see really clean balance sheets in technology. So these are things we're emphasizing: the clean balance sheets, the companies that have more stable like earnings. And then you got to be look at valuations, make sure you're not overpaying for that collection of good business with good earnings power.
Tony, you mentioned energy in that sector. We've already seen this have and compose some of the best performers year to date. So is that trade already missed?
I don't think so, and for a couple of reasons. There is a long-term supply-demand mismatch there, and the mismatch is really coming from restrained supply. You know, that sector went into, I'll call it a recession, back in 2014, where there was significant excess capacity. And since then, you've seen CapEx come down dramatically and stay down, and that's really important. And so when you look at companies today, even with high oil prices, you're not getting that supply response. And in fact, you're seeing good discipline out of OPEC, right? They just cut in, saying, look, the economy's slowing, we need to cut supply. And then also when you look at the Strategic Petroleum Reserve, right, we've been releasing about 1 million barrels a day. That's 1% of demand. Doesn't sound like a lot, but in a market like oil, that's normally very steady, 1% means a lot. And so we're about done with those releases come December. And so that's going to be another thing that's going to put a floor under pricing.
Tony, appreciate the time here today. BlackRock's Tony Desperito joining us this morning. Thanks so much. Coming up, Microsoft shares, they are on the move, but lower by about 7% here after its cloud revenue came in short of expectations for the first quarter. Piper Sandler's Brent Bracelin joins us next. Microsoft beat on the top and bottom lines yesterday, but the company's guidance fell short after the company reported softer than expected cloud revenue. CEO, Satya Nadella says that cyclical trends are weighing on the stock's consumer business. But could the company's plan to moderate expenses boost its stock? Joining us now to weigh in is Piper Sandler's internet equity analyst, Brent Bracelin. Brent, great to have you here with us this morning. For Microsoft, some of the larger headwinds that they had laid out, FX, PC, which of these do you see actually being able to abate in the near term of all of the headwinds that they mentioned, and how can Microsoft successfully navigate this period?
Sure, you bet. So clearly, you're starting to see kind of the macro pressure start to erode into the growth outlook for Microsoft. If you look at the cloud business, it actually is still pretty healthy. It's slowing, but we still expect the cloud business to grow north of 20% this year, a little slower than we thought originally 6 months ago. It's really the more economically sensitive parts of Microsoft. That's still a big business. That's still a $100 billion business. It has been growing across Windows and PCs and Surface devices and gaming. That's a $100 billion plus business that has been growing 4% plus for the last 2-3 years. It could actually decline double digits this next quarter. So it's really, that's really where we're seeing the slowdown in those more cyclically sensitive areas, more of the consumer areas. The commercial still holding up pretty well.
So that's sort of in line with what we've been hearing, Brent, from what the commentary we've been getting ahead of the earnings season from the likes of a Salesforce, for example, that have seemed to indicate that business spending is holding up pretty well. But how long does that last? If the cyclical stuff is rolling over, can we expect it at some point to also affect the more enterprise spending?
Absolutely, and you're just now starting to see small cracks in the cloud growth rate. If you look at Azure, it's one of the fastest growing parts of the cloud business for Microsoft. That growth profile is decelerated by about 9 percentage points in about 3 quarters. So you absolutely are seeing slowdown. It's still good growth, right? 37% in constant currency is what they guided to this coming quarter. That's down from 47% over the last couple of years. So it's slowing. We're seeing signs of maybe some budgetary pressure on the enterprise side. That's going to flow through into next year as well. So we certainly wouldn't say enterprise software cloud is immune to the macro, and we're now starting to see cracks.
Brent, clearly a challenging quarter for Microsoft. Outside of your, your coverage universe, or outside of Microsoft, are there other companies that you think will be impacted to the same extent as Microsoft?
Sure. We actually took numbers down on 22 stocks last week, including cutting numbers by Microsoft by $3 billion. Clearly wasn't enough. We took another $7 billion cut to our Microsoft numbers this morning. But yeah, we think there really isn't a safe haven in software. I think the macro pressures will eventually impact growth rates for most of the enterprise software names that we cover. So, I think the good news is valuations are starting to bottom. So I think there's no longer a valuation risk. The challenge, fundamentals have not bottomed yet. So we still have a bottoming process to go through on the fundamental side. We need to see growth expectations for next year reset. And we're getting close, but certainly have to go through a fundamental trough before you start to see stabilization.
What type of growth profile would you give at this point to Microsoft's cloud business, considering the pull forward in demand that we had seen over the past couple of years?
Yeah, so it's interesting. We look at the broader cloud market, the Cloud 100, if you will. Growth was 33% in 2021. We're modeling about 22% cloud industry growth in 2022. That's similar to where Microsoft Cloud is at. Next year, we're actually sub 20% growth for industry, about 19.5% industry, cloud industry growth expectations. That's essentially, I think, directionally where Microsoft's headed as well. High teens growth in a recessionary environment seems like a good kind of landing spot for this industry. That's down from 33. So that is a material slowdown, but still really good growth. for an industry that could be north of $300 billion in 2023.
With valuations sitting where they are right now, do you think that Microsoft, especially within this cloud landscape, needs to make a key acquisition and strike while the opportunity might be there to go after a company that could help it grow out its portfolio in the cloud a little bit better?
Listen, Microsoft's still the cloud king. It's the only cloud company north of $100 billion in revenue. It's still kind of growing, poised to grow 20% in constant currency. So could they do more? Absolutely. Should they do more? Absolutely. Do I think they will do more? Absolutely. So $170 billion in cash, $65 billion in cash flow. Microsoft's not done from an M&A standpoint in cloud. We expect them to be active next year.
Absolutely, times 3. Thanks so much, Brent. Appreciate it. Brent Braceland of Piper Sandler Equity Research. Appreciate it. Coming up next, we'll get a pulse check on the state of telecom with AT&T executive Jen Robertson. Don't want to miss it. Teeing up good news, you'll get that in a second. Raymond James, the most recent analyst to applaud AT&T's recent quarter, ticker symbol T, with a boost to strong buy from Outperform. This after the U.S. telecom reported its third quarter numbers last week, including a net gain of 708,000 prepaid subscribers. Joining us to talk about the company and the economic environment is Jen Robertson, AT&T Mass Markets Executive Vice President and General Manager. Jen, thanks for being here.
Thank you.
So as we look at these subscriber numbers, what I'm curious about is where they are coming from. In other words, are they coming from your competitors? Which competitors? And what is it costing you in terms of promotions?
Yeah, you know, we're really proud of the subscriber growth we've been delivering, and we're sitting at 9 quarters now in a row of 600,000 postpaid voice net adds or more, and delivering near record levels. So it's been an exciting time to be in the industry. Proud of how we're standing up against competitors, 2 million net adds year to date through the third quarter, and expecting that to be an industry-leading position as we move forward. So holding strong there, and certainly delivering that from a higher demand for connectivity. It is a resilient product and looking at customers and delivering value. And so, yes, there are promotional offers, but we are meeting customers where they want to be. We have distribution expansion that's occurred. We're meeting customers where they want to shop. A lot of trends that came out of the COVID pandemic that have carried forward and changed how people want to interact with us. And we're proud of how we've simplified our product and pricing construct and met customers where they want to be.
When you think about the advancements in the network too, one thing that we've heard over the course of this earnings season from telecommunications and communication services companies is where those investments are being made and boosting up the network. You know, how soon do you see that beginning to really play out for so many of the customers that you're serving too?
Right, so we've made investments, significant investments in the 5G wireless network. Proud to be moving towards 130 million subscribers and customers that'll be covered with our C-band spectrum by the end of this year, 200 million and more covered by 5G, and certainly the country's largest investor in fiber. And so putting those investments there because it's the connectivity that customers want. It is the technology that will meet the next decade plus of demand for customers, both on usage and on speed. And so that's why you see us really doubling down and putting our focus in those two network technologies.
It was talked a lot about in the earnings call, Jen, just improved value perception. So what are you doing specifically on pricing? Are you cutting prices of plans? Do you have any more plans to drop them even further?
I think actually we raised prices earlier this year on our legacy plans. And what I am really proud of the team for doing was taking a customer-centered approach to it. We looked at what customers wanted, and candidly, they want simple plans, they want choice, and they want to get more value. And so even as we raised prices in some areas, we had customers choose to move to our newer unlimited plans and upgrade their service and pay a higher price point because they saw the value exchange that was included in there. We allow customers to mix and match plans in our Unlimited Your Way offerings. We allow so they can right-size it for their household. We allow customers to have 5G included. So certainly a value to a customer where they felt, yes, I am getting something for this exchange.
I think people are still trying to figure out what 5G is and does for them, right? We've been talking about it for a couple years now. Full disclosure, we were owned by a phone company, a rival phone company before. We heard a lot about 5G.
Right.
Like, if I have 5G on my phone, is there a noticeable difference in how that phone is performing for me?
We absolutely, as we deploy our C-band spectrum, there is an absolute difference in speed and higher speeds that customers can experience. I think it's interesting, 4G technology had such a leapfrog in the use cases for customers that as 5G came out, I think our media cycle was earlier on the 5G hype and consumers and businesses looking at, okay, now how do I get the use cases out more quickly? And we forget that we're still in the process of deploying the network. There are certainly business use cases that are coming to life. Manufacturing, healthcare, a lot of opportunity there as you see us lean in. Connected car being one. From the everyday consumer right now, it is absolutely a speed increase.
Let's just say I use a competitor service for my phone, full and fair disclosure, and 5G for me doesn't pop up everywhere. What is it like on your service? Do you still see dead spots for 5G?
Yeah, I think it comes back to we deploy the spectrum in phases, and that takes time. And so you'll see 130 million people covered by the end of this year with our 5G C-band, where you'll have a noticeable speed.
You know, just lastly, while we have you, we think about the areas of the economy that have like these little luxuries that consumers will continue to buy in even during an economic downturn. Is your phone service, your cellular service, is that a little luxury that you're seeing people continue to spend higher for just because of all of the different things that we use our devices for on a daily basis right now too?
Right, I think what we see it is not a luxury, it's a requirement. Customers need connectivity for personal use, for business use, for learning, and commerce. And so it's actually a very resilient product, and customers are purchasing up. It's why our ARPU was up in the third quarter.
All right, let's leave it there. Jen Robertson, AT&T Mass Markets EVP and General Manager. Good to see you. Thanks for coming to our studio. Appreciate it.
Thank you.
All right, coming up, we'll chat with Mattel CEO Anand Krais as the toy maker gears up for the peak holiday shopping season. We'll be right back. Shares of Mattel are in focus after the toy maker trimmed its full-year guidance in its third quarter earnings report last night, saying market volatility and other macroeconomic risks has forced it to reformulate its expectations. Mattel Chairman and CEO Anand Kreis joins us now to discuss. Anand, always great to get some time with you. Your top takeaway on the quarter.
Thank you, Brian, for inviting me. Well, this was a good quarter for Mattel, with the 9th straight quarter of year-over-year growth in constant currency. Look, as you know, we are in the midst of a challenging economic environment, but our year-to-date results of double-digit growth in net sales, adjusted EBITDA, adjusted operating income, and adjusted EPS show that we are successfully navigating a complex landscape, and our strategy is working. We believe our fundamentals are strong, and we are very confident about our multi-year growth trajectory.
And Anand, I've been covering you and the turnaround story at Mattel for a good bit now. I wasn't used to that tone on that conference call last night, just highlighting some slowing you're seeing in the market. How severe has that gotten?
Look, it's not a secret that the economy, the broader economy, is currently challenging. But our year-to-date results do show and do demonstrate that we are on the right track. We are maintaining guidance for full-year growth in net sales in constant currency of 8 to 10% and look forward to the holiday season. We modestly revised our profit expectation to allow and accommodate for the inflation that we're seeing, but we still expect a growth year for Mattel, both at the top line and the bottom line, and also expect 2023 to be a growth year, both top line and bottom line. So we are very confident about our trajectory. Our brands are resonating, thriving with continued engagement and cultural impact, and we're very confident about our strategy and execution.
You did highlight the need that there might be a little more promotions in the holiday quarter than I think a lot of investors maybe expected. How much discounting do you expect to be doing?
Look, quarter to date, consumer demand is in line with expectation, and we're pleased with our performance. Shoppers are returning to traditional purchasing patterns closer to the holiday, and we expect demand to accelerate. We are working closely with our retail partners to meet the anticipated demand. We have more advertising and promotion. We secured more shelf space and retailer support compared to last year. And we also expect to, we have great holiday toiletries representation and much stronger in stock. So yes, we are going to increase activity, promotional activity, but we are well positioned for the fourth quarter and the holiday season, which is why we are maintaining our full year guidance of net sales growth in 8 to 10% in constant currency.
No, I'm old. I'm not as cool as I used to be. What are some of the top toys this holiday season?
Well, Monster High is going to be a very exciting offering as we prepare for the global launch next year. Hot Wheels Car Wash, Lightyear products. Fisher Price has a great musical toy called Bouncing Beats. And the Dream House, of course, will always be on the top of the toy list for every holiday season. So an exciting, broad offering across a pretty large spectrum of product that we're very excited about.
I remember having one of those car washes as a kid. I got to send you a photo. It exists somewhere. But these are some cool toys. That is some interesting stuff. I mean, how is the pricing on these compared to last year? Do you plan to take more pricing?
Look, we increased pricing in the second half of this year. We were able to successfully implement those increases, and it's too early to tell. But so far, we haven't seen a meaningful impact on consumer demand. Important to say that as it relates to inflation, we are beginning to see some improvement in the cost of ocean freight and materials. We expect inflation to moderate in 2023. And in addition to the savings that we're looking to generate of $250 million by the end of 23, we expect the combination of pricing and cost savings to more than offset cost inflation and contribute to margin expansion over time. So we are proactively managing our business in this environment to ensure that we're set up for long-term success.
You might be the first CEO that we've talked to really highlight a peak in inflation and things cooling off a bit. Certainly that is good to hear in a different tone. Let's go on to Barbie, because Barbie's been an interesting story the past year or two here. A real growth mechanism for the company. What's on tap for that brand next year?
We're very confident about the long-term growth trajectory of Barbie. Barbie was the #1 global doll property in the third quarter and year to date. Year to date, Barbie is up, which is an excellent achievement when compared to last year, which was the highest on record for Barbie of all times. We look forward to next year, which will have an exciting innovation pipeline, a new content slate with Netflix, and of course, the highly anticipated Barbie movie, our first theatrical release that will come out this summer. Also important to note that Barbie doubled in size over the past 5 years and was the #1 global toy property overall, not just in dolls, but overall in the last 2 years. And we really see that as a proof point to the strength of this incredible franchise. Very confident about Barbie and proud to have it as our leading franchise.
It does seem like, Ynon, and we've talked about this in the past, you've all the seeds that you have planted in terms of content, and of course you highlight the Barbie movie, are now coming to fruition. This will start to hit the market next year and beyond. How much will you spend on content next year?
Well, we employ a capital light strategy. We are not spending money on content. We are leveraging our brands. We collaborate with the best filmmakers and content creators out there, both not just film, but also in television, and partner with major studios to create, produce, distribute, and commercialize our brands on the big screen and also in episodic content. We have a very exciting slate of 14 additional movies other than Barbie that we currently developing with some of the best and most prolific creators of this generation. And this is going to grow up because we have more in the pipeline that we haven't announced. And likewise, Mattel Television is thriving with 12 series and specials that will be on air this year, so to speak, because some are actually via streaming. 8 of those are new, 4 are returning. Monster High live action television movie musical just launched on Nickelodeon, and we greenlit the second movie. And we continue to roll out more content such as Thomas and Friends, Polly Pocket, Fireman Sam, Deepa and Anoop, more Barbie product, Pictionary game show, and the list goes on and on. So exciting to see how our brands resonate with consumers and attract creators to collaborate with us, because like us, they're also very excited to reimagine and create an expression of our product in content.
When's the Pokemon movie hitting in on?
Well, we licensed recently the Pokemon brand, which is one of the strongest franchises this year for Mega, for building sets. It's been a great driver for us, and we're very proud to work with the Pokemon company in expressing their IP in combination with our product. So it's a great partnership. And this really speaks to how we elevate Mattel to become the partner of choice for the major entertainment companies, and where we bring our capabilities, our global scale, our innovation, our supply chain and commercial capabilities, collaborate with other owners, other franchises, and take them to the next level and create evergreen franchises, just like we do with our own.
And I'm just being flagged before I let you go, Ynon. There was just a new Pokemon movie, Detective Pikachu. That's how you know you're getting old, but you do not realize those types of movies are in the market. We'll leave it there for now. Good luck this holiday season. Mattel CEO, Ynon Kreiz. We'll talk to you soon.
Thank you so much.
All right, coming up, we'll zero in on some more key earnings reports from Visa, Halliburton, and Skechers. Looking forward to sharing that analysis. That's next.
Welcome back, everyone. It is time for Cut for Time. We've got 4 stories today, 1 minute each. We're going to start with this. Visa tracking ticker symbol V on the day. It's up by about 5.6% right now. This is after beating on Q3 earnings. The payment company says it still sees strong consumer spending. Payments volume, that grew 10% in the quarter, while transactions grew 12%. And this comes back to the type of spending that consumers are more prone to do at this point in time, leaning towards some of the card products and card services out there versus just saying, yeah, I'll pay with cash. They're trying to hold on to some of that cash. But
yeah, and all this travel that we're talking about, right? Yeah. How are people paying for that? They're putting it on their card. So again, this speaks to the idea that we're not seeing an across the board everything slowing down at once, right? It is very uneven here, and Visa's results, I think, are a good example of that.
American Express, good quarter last week. Visa, good quarter. I'm not surprised.
Well, and on the travel front, as you mentioned, American Express had cited global travel or corporate travel, especially given that American Express has so much of the corporate T&E that they kind of account for within that landscape. But for Visa, that clearly playing out for them too.
Yeah.
All right, Halliburton saw earnings double in the last quarter as demand for crude oil increases, leading to an upgrade from Wells Fargo today, which is sending shares higher. The bank upgraded the stock from underweight to overweight. So pretty simple analysis here. Oil prices up. Good quarter for Halliburton.
Yeah, although it's not always as straightforward as that, right? You need the demand for oil services as well, and not just the increase in oil prices. I mean, the price target jump coming from Roger Reed over at Wells Fargo is pretty impressive, to $52 from $33. So he's looking for a lot more upside. So are a lot of investors we speak to, right? We just talked to Tony DeSpirito over at BlackRock. He mentioned energy as an area that he likes right now, and he's not the only one, even after the climb that we saw in energy stocks, especially in the first half of the year.
Yeah, I mean, it's really a story as well, though, within all of this, of pricing. Their pricing increased in North America and international markets. They're saying that the strength of their strategy in action was really kind of resulting in this revenue growth of 6% sequentially there, and really led by some of that pricing and the macro environment right now, too.
On the other end of the spectrum, we have Skechers, the footwear manufacturer, seeing shares dipping today after missing third quarter estimates, give a downbeat outlook for the current quarter. The shares off 4.5%, and I'm seeing a lot of analyst concern being expressed over the margins and the target for margins as well for Skechers. So again here, illustrating the lumpiness in consumer spending, right? People maybe are traveling, maybe people are buying some shoes still, but they're not buying as many Skechers, and it's costing the company more to get them out there and maybe to move them out the door too.
Inventory up 21%, red flag.
But it still comes back to the core consumer that Skechers is going to go after here. We've seen them move more into some of this sport or leisure activity category. They've got a number of PGA Tour, some now live golfers, I believe, that are still on their roster. And so with that, it's this larger question of when you've got a millennial and Gen Z population that have clearly shown what their brand affinities are, Nike, Lululemon, and then additionally Crocs, as well as one of the kind of growth areas that we've seen in some of the more kind of comfortable shoes. Where does Skechers sit within that too? I think that's a larger question that the brand is still going to have to answer for.
All right, now we're looking at Wingstop. Shares of Wingstop taking flight today after the fast food chain announced prices of bone-in chicken wings are actually decreasing. The falling prices prompted Wingstop to raise its full-year guidance. So this is what we've heard for Wingstop in recent quarters. Deflation in chicken wing prices. Really one of the only fast food companies that I can think of actually seeing deflation in parts of their business. Wingstop benefiting from that.
They just got into the chicken sandwich game. Mad late. That's the analysis.
Yes.
Well, they may be seeing deflation in chicken wings, but they're probably not seeing deflation in labor costs, right? I mean, that's something I think that is still, we're seeing upward pressure on that across the board for anybody within the food business specifically, because people still don't want to come back and work in that business.
No, it's true. And at the same time, where Wingstop is also still trying to navigate what that direct correlation or that direct touch point with the consumer is, while many of those consumers have options on the table to get delivery through some of the other third-party sources as well for their chicken wings. However, falling chicken prices held them that out.
All right. We are seeing stocks now mixed right now, and coming up at Kiko Fujita, we'll continue our coverage of earnings from tech giants Alphabet and Microsoft with Technolosys Research President Bob O'Donnell. Keep it right here for that.
Welcome to Yahoo Finance Live. It is 11 a.m. here in New York City. I'm Akiko Fujita. Here's what I'm watching at this hour. Big misses for big tech. Results season serves up some uncomfortable questions for the global economy. Underwhelming reports from Microsoft, Alphabet, and Texas Instruments all weighing on sentiment this morning. Too strong for too long. The greenback, the dominant currency for most of 2022, but a broad move against the dollar takes place in global FX. So the question here, are we at peak hawkishness? We're going to ask Global X ETF's Morgan Deldone later in the show. And in this economy, Intel's Mobileye prices its long-awaited IPO above the targeted range. Could Stripe and Instacart be next? We're going to get into that conversation later this hour. First, though, as always, we are checking the markets right now. 90 minutes into the trading day right now. The Dow is up about 240 points. The Nasdaq, the big one we're keeping a close watch on the back of those big tech reports. Of course, we're going to be breaking down Microsoft as well as Alphabet. Meta on tap after the bell today, one we're going to be watching closely. Taking a look at where the bond markets are right now. We have seen a bit of a pullback here, but the shorter end still well above that 4% level, 5-year at 4.2, and the benchmark 10-year just right about at 4%. Well, shares of Alphabet are sliding into the red after missing estimates on the top and bottom line. The tech giant's revenue growth slowed to 6% from 41% the prior year as ad spending continues its downward trend. Lapping from a strong third quarter last year, made for some tough comps across Alphabet's portfolio, including search and YouTube. Take a listen to what we heard from Google and Alphabet CFO Ruth Porat on the earnings call.
In YouTube and network, the sequential deceleration of year-on-year growth in the third quarter versus the second quarter primarily reflects further pullbacks in advertiser spend. In the fourth quarter, the very strong revenue performance last year will continue to create tough comps that will weigh on the year-on-year growth rates of advertising revenues.
Joining us to break this all down, we've got Bob O'Donnell, Technalysis Research, President and Chief Analyst for more on the impact tech companies are starting to feel from an economic slowdown. Bob, we've got you in the flesh.
It's so great to be back live in the studio. It's crazy.
Certainly a good day to break this all down.
Yeah.
We're going to start with Alphabet because, we were saying before the show that it's interesting to see how significantly they were affected, especially in digital ads. When you think about the last quarter, there was a bit of a divergence between the social media companies.
Right.
Alphabet has a bit more of a diversified portfolio, but they weren't shielded this time around.
No, because obviously Alphabet gets search, and we're always going to search, and people are always going to do that, and so they always have that they can fall back on as part of the advertising side. But the social media side and the YouTube side of things, that's where they took the hit, and that's because we're seeing obviously overall advertising going down in those places. And the other challenge that you've got with Alphabet is it's not really that diversified a company, right? There's so much dependence upon advertising. Look, they do have Google Cloud, which they didn't really talk too much about that, but they have a few things that are bubbling up, but they're still small. I saw a note the other day that other bets. Remember when they used to talk about other bets? It's 0.3% of the company's revenue. So. I think that's one of the ongoing challenges. They're going to figure these things out. They are building their business not only on the enterprise side, I should say, not only for Google Cloud, but also Google Workspace, some of their other services where they compete with Microsoft. And that's been growing, and it continues to grow. It's going to take a while before it becomes a huge contributor to the bottom line. But there are these elements that are in play and that are moving forward for them.
What was your takeaway, though, from what we heard in terms of where things are headed? It seemed like they were sort of setting things up for an even more significant downturn. And to your point, yes, it's not as diversified as a company like Microsoft, but in terms of where the ad revenue and where they compete in, it is a little more diversified than the likes of Meta or Snap.
Yes, no, it definitely is. And look, I think what we're seeing in a lot of ways across tech is a sense of the things that people expected to happen at the beginning of the pandemic didn't, and now they kind of are. It's sort of like it's a 2.5-year delay of the big impact that people thought was going to have. I think in general, we're seeing that tech companies, having weathered so well, are now facing the challenges that other parts of the market have faced. And it's just, that's the reality. Growth is going to slow down. And on the advertising side, of course, that's a reflection of overall macroeconomic trends. And there's not a whole lot they can do about that. And I think that's a challenge. Obviously, there's not many more places they can go. I mean, Google is everywhere and their stuff is everywhere. So it's really going to be dependent upon how the general macroeconomic does, so that those companies then feel more confident, their advertisers, I should say, feel more confident in spending the money with a platform like Google.
Let's talk about Microsoft. Obviously, Azure's been the big growth driver there. And you have said in your notes that because it is more enterprise facing, they are a little more shielded. And yet what we heard yesterday, I think it was on the call from Google, saying essentially, yes, companies are still investing in the cloud, but they're taking a little longer and maybe thinking a little harder about how much they want to invest. So are we likely to see further headwinds for Microsoft, even if Azure is the driver?
I think we will. And the issue is, it's easy to forget that only about, I think the last numbers I heard were 15 to 20% of companies have moved their workloads to the cloud. Or I shouldn't say of companies, of the potential workloads. And so there's still this huge potential upside to move to cloud computing from all the big platforms. And the other thing to bear in mind is we've had these incredibly strong growth rates for cloud computing across the board. AWS, obviously Microsoft, and at some point, you can't last, right? It's the law of big numbers. You run into a certain point where it's very difficult. The thing is, even as things start to slow down a bit, a lot of companies started big initiatives during the pandemic that are cloud computing based, and they are going to continue those. Like you said, as the commentary said, some of those projects are going to slow down a little bit. They're not quite as high priority perhaps as they were, but they're still going to do it because it's still part of these companies really kind of trying to transform their businesses, and that's an essential part of survival, in the next decade.
We're still waiting on numbers from Meta. We've got Alphabet or Amazon and Apple later on in the week. It's sort of interesting to see how the narrative around tech has changed, because for a while it was about the social media companies. And yet when you think at where we are in the current quarter, it feels like we're going back to sort of these established players, if we can call that. Yeah. It has come down to Apple, it comes down to Microsoft. I mean, how are you looking at your portfolio of those tech names, and where are the safe bets?
Yeah, no, I think we are falling back to the most trusted tech brands, and the big names are going to be the ones that are going to, I think, make it through this. The other thing is, again, these companies over the years have become increasingly diversified. Now, in the case of Meta, I think it's a challenge, right? Obviously, very advertising focused, very consumer-based advertising focused, so likely it's going to be tough. Apple, everybody loves to say, well, one of these days, something's going to catch up to Apple. But what Apple magically manages to do every quarter is somehow get different elements of the puzzle to add together. There have been rumblings that iPhone 14 sales, for example, have been lower than expected. So they've, apparently cut the production. And so people say, oh, well, see, iPhone's going to be down. But remember now that iPhone is less than 50% of the revenue. They've built up this huge install base. They continue to sell services, right? Everything from Apple TV and all the other services they have, that's driving their growth. They're also doing more, obviously, with AirPods and the watch and other elements of their ecosystem. So they've managed to create this, I think, pretty diverse story. Similar to Amazon, right? I mean, Amazon is, very dichotomous. You've got AWS, which just cranks out revenue and cranks out, dollars. And then you've got the online sales business, which realistically is probably going to, take a hit if it's going to be like any of the other retail environments. But the question is there enough on the, AWS side to offset some of that? It's hard to tell for sure. But again, it's that story of diversification that these big tech companies have done over the years, and I think we're going to start to see the benefits of that, but clearly at more of a reduced kind of a normal rate, not the huge multiples that they've gotten.
Yeah, a lot of investors are going to be parsing those numbers or breaking down those numbers closely. Bob, great to have you in studio today.
Thank you, Kiko. Great to be here.
Bob O'Donnell, Technalysis Research President and Chief Analyst. Well, macro headwinds no doubt taking a toll on corporate results, as we've been talking about, and underwhelming numbers for big tech, pointing out some glaring weaknesses in the global economy. Major data points held above water for some time, but is the slowdown we've been fearing so long finally here? We've got Inez Ferre and Julie Hyman Julie making an appearance on the 11 a.m. show. Let's start with the earnings, because we just went through the big tech ones there, but there's another one that I know, Inez, you've been watching, and that's Texas Instruments.
Yeah, that's right. And Texas Instruments is important because their chips go into everything from home appliances to missiles. So the scope of where their chips go is very significant here. And Texas Instruments basically saying that they are seeing softness, especially also going into the industrial segment. So that industrial segment that seemed to be immune to sort of a softness inside in the chip space, a slowdown in the chip space, that is notable. Now, analysts had been talking about that we would see a slowdown in the chip space, especially in the second half of the year. But again, that scope, you also have, of course, the Biden administration restrictions when it comes to chips and China that's also weighing on here. But the bottom line, from what I can glean from this, is that basically this slowdown that we're seeing, it's not going to be a quick turnaround. Julie, your thoughts on that?
Well, it's interesting what's going on with Texas Instruments. It seems like everything slowed except autos is what analysts were pointing out. That was actually a bright spot, because that's a spot where our automakers are sort of in an arms race where that is concerned. So for me, the takeaway is that this is very lumpy. And this is something we were talking about in the last hour. Not just within chips, but within everything, right? Because if you look at results from something like Visa, which was out with its numbers as well, from there, the indications seem to be that consumer spending is still relatively strong on things like perhaps travel, right? So it's not that businesses and consumers are not spending. It's the spending is on different things. They're spending perhaps less, maybe overall. Certainly companies seem to be, judging by the results from Microsoft, for example. But it's not sort of an across-the-board things falling off a cliff. It's this sort of lumpy slowdown.
But doesn't that go back to sort of like how do we look at what the macro picture looks like, right? I mean, we've been talking so much about how there's this divergence between where consumer sentiment is versus where consumers are actually spending, and that yes, there are concerns about higher prices, and yet when you look at sort of the broader labor market, things are still pretty tight. And this sort of seems to add to that idea of it being a little noisy and not being able to have a very clear picture on where things are headed.
Yeah, definitely.
And if you also look at the home data, for example, I've been also watching that, because as housing goes, so does the economy. This is another area where we are seeing September new home sales were down in September. And you saw also in September the mortgage rates, those climbed up to by 100 basis points. That's a huge amount in 1 month. So now it's just sitting just around 7%. You are going to see a slowdown in this, in the housing market. We are already seeing it. And keep in mind, housing is a lagging indicator. So when we're talking about these different areas of the consumer, how the consumer feels, where it's spending its money, housing is a huge component of the economy. It encompasses so many jobs, from construction to mortgage lending, and then it also encompasses the durable goods. So dishwashers, everything that has to do with building a home and what you put inside the home. I think that there's different areas, as you mentioned, of the economy. It is a little bit lumpy, and it's just which areas do you want to focus on, and which are lagging, and which are the ones that indicate.
Well, in going back to what we've been learning from earnings, I mean, Chipotle is kind of an interesting story. You know, they raise prices, a lot of companies have, to offset the cost.
Yes.
They did beat expectations, and yet it does seem to suggest that there are trade-offs that are happening among consumers.
Well, and they talked about that the lower income consumers are not coming in as often. Transactions actually fell at Chipotle by 1%. They're going to fall by a higher percentage in the current quarter, according to the CFO, Jack Hartung, who we spoke with earlier today. And so not only are you getting lumpiness among what consumers are spending on, there's a lot of differentiation amongst consumers. So whereas a higher end consumer might still go out and spend a house, even though buy a house, maybe they're spending less on that house. Likewise, you're going to have a big differentiation between higher and lower end consumers and what they're buying, where they're traveling, et cetera.
Well, I mean, even that, even if, you know, so lower income customers aren't coming through the door as much, higher income maybe spending more, but even for higher income, that is a trade down, right?
Yeah, it could be, definitely, if they're buying Chipotle and not Capitol Grill. I don't know, we're like,
I don't know where they lunch. I'm not.
Right, exactly. But yes, there could be some decisions being made there.
And we know that inflation impacts the lower income consumer as well. So that is expected. These are, we've seen it with even the dollar stores in the previous earnings, where they show where consumers are spending, and they're maybe not spending on the t-shirts, they're now spending on food, on the consumable products.
Yeah, something we've heard from other retailers too. Groceries over other purchases. Good to have both of you on. Thanks. And that's Ray and Julie Hyman. Well, coming up, eye on the prize of Fed hawkishness is peaking. Does that mean the IPO market can get back to its feet? Intel's plans for its autonomous driving unit should help boost sentiment. That discussion's on the other side. Well, balancing act, Elon Musk's deal to buy Twitter slated to close this Friday. Bloomberg reporting that the Tesla CEO confirmed that in a video conference with bankers funding the deal. The timing, though, making some people nervous. With less than 2 weeks to go until the midterms, there are growing concerns about social media companies and how well they're equipped to handle disinformation and content manipulation. Let's bring in Yahoo Finance's Alexis Keenan, who's following that story for us. And so, number one, we're looking at this timing potentially a little clearer if it closes on Friday.
If.
How quickly, and that's a big if, how quickly can Elon Musk move to change the platform as some have speculated he would?
So I've heard some legal experts say, and whether they're the right ones or not, but they say it could happen immediately. Look, it's going to be a private company. He could turn this thing on a dime. So this makes it a very interesting and delicate time, really, for Elon Musk to be taking over this company because you do have midterm elections coming up November 8th. And these companies, social media companies, Twitter and the rest of the major US companies, they're they're all tasked with having a really robust content moderation policy around leading up to elections and after. Certainly that's been an expectation ever since the report came out, the Congressional Bipartisan Reports in 2016. So also though, Musk is working to sustain demand on the Tesla side. So he's got to balance this, but also he is having to keep that demand up with Tesla stock being down since the acquisition about 31%. And I'll tell you why in a second. But first, let's hit the fact that neither Tesla nor Musk have responded to explain exactly what is going to happen with content moderation on Twitter once and if the deal really gets done here, that deadline being Friday at 5 o'clock. Though Twitter has, for its part, in August, reaffirmed its position. Its policy is called the Civic Integrity Policy, and what it does is it offers prompts to users that direct them to information that the company deems accurate, and it also adds labels to content that it deems misleading. So that policy in effect, but maybe not so much after Friday. But also it's been raised by some of the legal experts I've been talking to, concern about Musk straddling not just the work responsibility of SpaceX, Tesla, his other companies, and then bringing Twitter in, but really trying to manage and be the arbiter of what lives and doesn't live on Twitter when it comes to world leaders. We've seen in the past a lot of discord about labels that have been put on lawmakers' content, both in the US and abroad. That's still going on recently with lawmakers in Ukraine, in the Russia-Ukraine conflict. And so does Musk want to be in that position? That's a question that I hope he answers soon. It's going to be a difficult balancing act once he is faced with those decisions.
You have to wonder what his feed is going to look like too. I mean, you're talking about global leaders, and he has sort of meddled in or weighed in on what happens with Russia and Ukraine. He gave that interview with the Financial Times where he talks about what should be done with Taiwan. When you are leading that very platform where the discussion is happening, you know, sort of do the rules change? And the larger question everybody keeps asking is, what does it mean? Those people who were kicked off the platform, like a Donald Trump, are they going to instantly be reinstated?
We don't know, but yes, it could end up being a problem that Elon Musk doesn't want to handle. And yes, could he push these responsibilities off to others who are running the company? Sure, but at the end of the day, the buck kind of does stop with Elon Musk so long as he is the sole owner of this company. We'll have to see how it plays out, but certainly he's going to have to continue to try to curry favor in China, in Germany, and other places where Tesla is operating, and make sure that he's pleasing world leaders, people of power on the content moderation level.
And we don't know for sure that he wants to be the CEO and he's going to be running.
We do not know.
All to be determined there. Alexis, thanks so much for that. Well, Intel's self-driving car unit Mobileye priced its initial public offering at $21 a share late Tuesday. That's above the $18 to $20 range. That values the company at roughly $17 billion, more than the $15 billion Intel paid for the company back in 2017. But a ways off from the $50 billion valuation it sought last year. Let's bring in Yahoo Finance's Dan Halley, who's been watching that for us. And Dan, you know, there's a few questions that come with this. Number one, given where the IPO market has been, does the fact that Intel prices at a higher range suggest the appetite is back there again?
Yeah, I think that's really the big question for this kind of listing, right? This is Mobileye, just to give you some background. This was a company that was originally developing technology to be able to provide computer vision for self-driving cars. Obviously, it's gone heavy into self-driving. Intel picked it up some years ago at around the $15.3 billion mark. And now, as you said, according to these reports, its IPO is being priced at $17 billion. But you know, that's below, again, as you pointed out, that $50 billion that was originally being looked at. And this all has to do with just, you know, the IPO market kind of falling off after a big 2021, big 2020, big 2019, where we saw some of these mega companies go out and hit the public markets. Now, we haven't seen very many that are doing $1 billion more in their IPO or more in their IPO. We have Mobileye here barely touching $1 billion. But I think it does point to some interest in this kind of company and the long-term growth perspective for something like this, where, you know, there is still a lot of work to be done in self-driving cars. in computer vision when it comes to vehicles. And so if Mobileye goes public and can get some clients under its belt, then I think that just means that the opportunity really is there for growth. Now, when we talk about self-driving cars, obviously, the discussion ends up pointing towards something like a Tesla, GM. What those companies are offering really are just driver assistant technologies. It's not really self-driving, no matter what companies call it. It's just still driver assistant technology. So this self-driving will still take years to kind of shake out. So there are ample opportunities for companies like Mobileye to kind of really fully establish themselves in the space and then become really the main client for some of these larger automaker brands and see where they can bring the technology going forward.
Dan Halley is always staying on top of the big tech stories for us today. Thanks so much for that. Well, coming up, green champions, California leading the charge on clean tech and sustainable innovation. But the question is, are those investments being made in an equitable manner? We're going to hear from one man who is ensuring that's the case, at least in Los Angeles. That discussion is on the other side. The Biden administration has set out to deploy more than 500,000 EV charging stations by the end of this decade. It's part of a larger ambition to slash the number of all gas-powered cars in the U.S. by half by 2030. Making that transition equitable, though, could be a challenge, with the majority of charging stations deployed in predominantly white neighborhoods. And our next guest is trying to change that through a unique incubator in Los Angeles. Let's bring in Matt Peterson. He is the CEO of LA Clean Tech Incubator, the segment presented by BMW. Matt, good to talk to you again. You know, it's interesting. In preparing for this, I was looking at a map of where all the charging stations are right now, and it's really glaring to see how concentrated they are in sort of predominantly, you know, wealthy white neighborhoods. I mean, can you talk about what the landscape looks like in LA, where we have seen significant transition to EVs?
Yeah, well, great to see you, Kiko. Thanks for having me on. You know, when we look at new markets and emerging markets, obviously the signals from policymakers in California really put the investment into electric vehicles and the charging infrastructure that makes it possible. Now, what that means is that the early adopters have predominantly been on what we call the west side of Los Angeles, in our case, which is predominantly white. And what we are doing as an organization through our Transportation Electrification Partnership is seeing how we can accelerate investment into low-income disadvantaged communities, meaning those communities that have socioeconomic challenges, disinvestment, redlining, historical and institutional barriers to really getting access to the services they need, whether it's adequate transit or transportation, let alone electric vehicles. So by doing pilots and advocating for policies like we successfully advocated for a statewide zero emissions vehicle advocate for disadvantaged communities, or equity advocate as we called it. Now the governor's going to appoint that person for California to help address some of these inequities. But in the meantime, we're working on putting charging and EV car sharing into places like public housing, where we know populations, people that live there don't have access to adequate transportation, suffer from worse air quality, and really can benefit from these kinds of solutions right there, available exclusively for them.
Matt, can you talk a bit more about the structure of Lacey? I mean, it's interesting to see how you're sort of playing this from both sides. You're obviously investing in some of these startups that are addressing those very issues you talked about, but you're also deploying these charging stations into more low-income communities and exposing them to them so that there's not as big of a divide in terms of going from a gas-powered car to an EV.
Yeah, I think we're helping entrepreneurs on one end, particularly Black, brown, and female entrepreneurs who have a tougher time getting access to capital. So how do we provide them additional resources and support to get access to capital, including from our own venture fund and, excuse me, debt fund that we provide low-cost financing to them for capital access and working capital. But at the same time, how do we work with local governments and city officials to bring the charging where it needs to go? So our utility partners like Edison and LADWP are making programs available to invest in chargers in lower income neighborhoods. But how do we accelerate that? So we're doing a pilot in a community known as Huntington Gardens that's going to be a fast charger at the street near multifamily buildings, a predominantly low income neighborhood, so that we can then educate people about electric vehicles, make public charging available to them, and demonstrate where it is. And how do we also target people that drive Uber and Lyft? How do we get TNC drivers behind the wheel of an EV? And that kind of public fast charging is going to be critical. Well, we then work to get level 2 charging, the slower charging, inside of multifamily building, apartment buildings, so as people can take advantage of the used EV tax credit and the Inflation Reduction Act to buy more affordable EVs, that they have a place to charge.
Finally, Matt, you know, California has kind of been on the front lines of this transition to go all electric. You've been working very closely with the mayor, Garcetti, there on the ground in shaping LA's policy. Now that you see where the federal government in this administration is trying to take it, I wonder if there are any lessons learned from California/LA's transition, if you think there's a glaring missing piece when you look at federal policy to address this issue.
Well, not every state has a utility pursuing aggressive targets based on public policy or their own utility's commitment to the market for electric vehicles and the charging needed. Not every state has the rebates and additional incentives that California has. So how does the federal government go in and provide support directly to cities as much as they can? So through the competitive grant program, through the bipartisan infrastructure package, some cities will be able to access those dollars for charging directly. Their state energy offices may not be as interested in deploying those charging stations with funding from the federal government equitably into lower income neighborhoods so that people can access the benefits of electric vehicles by having the charging infrastructure in their backyard. The other thing is making sure that those chargers are working. You know, if you drive an EV, sometimes you may experience a charger that doesn't work, and 80% of the time that it does not, it's a non-electrical issue. It means that the Wi-Fi connection's down, something like a software issue. So we have a company that we've incubated called Charger Help that's out there making sure we have uptime. So the federal government can make sure those that benefit from the federal government dollars, make sure those chargers are working 95% of the time, and that there's a company like Charger Help making sure those chargers are working, diagnose them, fix them, keep them up and maintained.
Yeah, it's certainly been great to watch the progress of everything you've done over at Lacey. Matt, good to talk to you today. Matt Peterson, CEO of Lacey. Well, coming up, King Dollar's crown slips a touch. USD ticks lower against major counterparts as investors reassess the outlook for rate hikes on cooling data. We'll look at the impact from policy on the other side of the Atlantic next. Results season has seen the likes of Coca-Cola and Microsoft cite the impact of the strong dollar, but has the story seen its peak? Let's bring in Yahoo Finance's Jared Blickery, who's taking a closer look at some of the key charts we should be watching. Jared.
Let's start with the Dixie. This is the U.S. dollar index. It is heavily weighted to the euro. Some people consider it anachronistic, but nevertheless a very good overall gauge. It is down 1%, and you got to keep tabs of who's rooting for a lower U.S. dollar. It's just about everyone, anyone who likes higher risk markets. And here we have a 3-month chart, and indeed we are testing the lowest levels here since about 1 month ago. And if we take a look at a longer-term trend line, this is going to be year-to-date. You can see we broke through to the downside a couple days ago. This is a rather steep interpretation. You can also see on a technical basis there is another trend channel which is in play here. Also not shown is a 50-day moving average. Suffice to say, the U.S. dollar, the Dixie, at a critical level here. Also want to show you, and we're going to get back to currencies in a second, that we have volatility coming down. We have the Fed in a blackout period. We have earnings season underway. We have mega cap earnings in focus. Meta's after the bell. Apple's a big one. Now, everything's setting up for a potential rally into the end of the year, also based on factors such as the November election. That's just around the corner as well. Midterm seasonality coming into play. Here is the VIX of the VIX. We can see this second derivative, maybe it's a third of stock option volatility. This is testing the lowest levels since July. And you take a look at the VIX, which is a little bit closer. This is what people usually look at. This is trending down as well. So let's take a look at what's been happening in currencies. And Akiko, you and I follow the Japanese yen on almost a daily basis. The yen is off by the dollar about 1% today, but I've been looking at the Chinese yuan. The renminbi is down 1.35%. Doesn't seem like a lot, but on an offshore basis, this is the onshore. The offshore, which has been trading since about 2011, this is the steepest decline, I believe, on record. So we can see that the US dollar has been strengthening considerably, and we have been concerned that the Chinese yuan may be devalued in a disorderly fashion. That's what happened in 2016 at the very beginning of the year. We'll have to see if there's a repeat of that, but so far, if the mega caps, I believe, can participate here, we do have the impetus for a risk rally, but we got to see that US dollar ease and continue to ease as well.
Okay, thanks so much for that, Jared. We're going to stay with the dollar. Our next guest says she believes the greenback is poised to stabilize amid more aggressive ECB and BOE hiking paths toward the end of the year. It comes amid growing evidence that tightening has started to weigh on the U.S. economy, fueling expectations the central bank will temper the pace of its rate hikes. Joining us in studio, we've got Morgan Deldone. She's Global ex-ETF's head of investment strategy for Europe. Morgan, good to talk to you today. It's certainly fitting when we've started to see a bit of a pullback in the dollar. I was thinking back to even a month ago where we had guests on who were saying it's going to remain high for a very long time. Feels like we made a pivot pretty quickly.
Absolutely. I think we are in a turning point because when you look at the rate differential going forward and looking at the path the ECB and the Bank of England are taking as an aggressive, at least as aggressive as the Fed or even more in the near term, the rate differential won't lead to stronger dollar. Then you look at the US economy starting to feel the higher interest rates and probably going to a soft landing scenario. So overall, from an economic standpoint, interest rate standpoint, it seems that the dollar is poised to stabilize with increasing downward pressures.
What's the expectation on your end on how exactly the Fed moves next? I mean, yes, to your point, there's been sort of slowly this expectation building in about the Fed maybe at least pausing or slowing those rate hikes, but we've got another meeting just around the corner. What are you anticipating then?
I think it's really too early to say that the Fed is going to pause like on its rate hikes. I do think that the main input for the Fed's decision to continue to prescribe 75 basis points is coming from inflation data. And I do see a case that the Fed continues at this pace until it sees a real inflection point in the CPI numbers, which is not yet materialized. So I do think that the Fed is going to continue to hike 75 basis points next week and potentially in December, but then we'll be not far off the 5% mark, which is probably very close to the peak for the Fed's fund rate this cycle.
The Fed has really been leading the way in terms of how quickly they move, how aggressively they move. When you look at major central banks around the world, you mentioned the ECB, the BOE, of course the Bank of Japan. In Europe, though, we've already seen a pullback. In the expectation seems to be going into the winter, things could get even worse when you think about where energy prices are going. How aggressively do you think the ECB, for example, will need to move as a result of that? Because they have been moving just a little step behind the Fed.
I think we have already passed the peak pessimism across Europe. I think now the economic outlook is becoming more stabilized, which also will help stabilizing the euro-dollar currency pair. Because I think when you look at the reserves in terms of energy, we are 88% full. We have very little leverage left on Russia in terms of gas imports. It's about 9% now of what we consume. You also look at the economic data. They haven't reflected a massive downturn. They're looking at some softness, but nothing that is critical. So looking ahead with all this fiscal stimulus coming in continental Europe, and it really gives the ECB the power to step up in terms of interest rate hikes, and bearing in mind that they are starting from a much lower base than the Fed. So playing catch up there, I think.
Finally, really quickly, I know you're focused on Europe, but the Bank of Japan increasingly in focus here. We've seen two interventions as far as we know in terms of the currency markets. You've got the governor there, Kuroda, stepping down in April, and yet there's still questions about whether, in fact, they're going to pull back on this yield curve control given where rates have moved. How big of a risk, when you look at it from the European perspective, how big of a risk does what's happening over in Japan pose?
I think it's So far, Japan, the Bank of Japan has kept its accommodative stance despite other central banks increasing. So I don't think there will be a massive U-turn in Japan. And I think if you look at toward the end of the year, the risk of having a more hawkish stance from the Fed, Bank of England, and ECB has reduced dramatically, which will help potentially reduce the risk of Bank of Japan having a surprising move in the coming months.
Cushions the blow a bit. Morgan Deldon, Global X ETFs, head of strategy there. Good to have you on today. Well, coming up, spending digital funds as another crypto debit card hits the market. Are you trying to navigate spending limits, regional restrictions, and even knowing if staking is needed? We'll discuss with Blockchain.com CEO Peter Smith on the other side. Well, checking in on the crypto market, we're seeing Bitcoin back above 20,000, while Ether is back above the $1,500 level. The rally fueled in part by investor optimism after UK lawmakers voted to recognize crypto as a regulated financial instrument, although the bill still has a ways to go before it is passed into law. The crypto market, by the way, topping $1 trillion after 3 weeks under that level. So what is a crypto holder to do with these gains? Our next guest may have an option. Joining us now, we've got Yahoo Finance exclusive Peter Smith, CEO of Blockchain.com, joining us, as well as Yahoo Finance crypto reporter David Hollerith. And Peter, you're of course here to announce or debut this new debit card that you're launching in partnership with Visa, also powered by Marqeta. Walk us through how this all works.
Yeah, sure. So the idea is that you can take your card, which looks like this. It's a fun little design. And you can easily spend from any balance inside your blockchain wallet. So you can spend from your dollar balance, your euro balance, your Bitcoin balance, your Ethereum balance, any of the sort of 30 plus assets inside of your blockchain wallet. And you can toggle between which asset you spend from sort of at any time. We're launching that in the US now, and then we'll expand out to the EU early next year.
Peter, we chatted yesterday about why Blockchain.com was issuing this debit card now, and you said that it came down to a lot of customer demand. But I was curious if you would just talk more about that and explain exactly how you see customers using crypto to spend on real-world goods and services. Because I think there's obviously a lot of questioning about, where spending is for crypto.
Yeah, so I think, as customers become more and more crypto-centric, so they're starting to think about their spending patterns and their financial health from a crypto-first angle, they want to be able to spend their, assets, their net worth, in daily life. And right now, one of the most challenging parts about being a crypto user is the fact that it's really hard to spend your money, to spend your wealth in daily life, because the links between the crypto system and the traditional banking system are quite tough and frankly slow. And so the reason that we're excited about the card is because it allows people to keep their assets and to keep their funds inside of the crypto ecosystem, but to be able to spend them in everyday life.
Peter, this comes at a time when we're sort of seeing the shakedown in the space, trying to figure out who's getting in, who's getting out. From a demand perspective, what does that look like for your card right now? And what does that tell you about where the interest is in the space?
Yeah, so we had the waitlist open for a really short period of time, and we had about 50,000 people sign up for it. And so I think, there's still a lot of demand for crypto products, but you're seeing that demand shift away from sort of trading and more towards folks that are interested in using DeFi, using their balances. Right now, stablecoin use is growing really quickly on our platform. And so when you look at the assets that people are holding inside of their accounts, you're seeing people hold a lot of stablecoin and Bitcoin, frankly. So you're really seeing like a pullback towards quality of crypto assets.
Blockchain.com CEO Peter Smith, and thank you so much for joining us today, and our thanks to David Hollerith as well for joining in on the conversation. We've got much more to come here on Yahoo Finance Live. We'll be right back. Welcome back to Yahoo Finance Live. The Clorox company has announced a recall on some of its multi-surface and all-purpose cleaners that the company says may contain some bacteria. The products recalled by the California-based firm include scented Clorox Pro Pine Sol all-purpose cleaners and Clorox Professional Pine Sol Lemon Fresh cleaners. According to the U.S. Consumer Product Safety Commission, the items recalled may contain a bacteria that's found widely in soil and water. The commission's advised consumers to take pictures of the bottles if you have them, throw them away, and contact the company for a refund. And we are getting back into the swing of earnings season. Tech certainly a big focus, with Amazon now set to announce their third quarter results Thursday after the bell. For more on what to expect, let's bring in Yahoo Finance's Ali Garfinkel. And Ali, you know, we always look to AWS as the big driver for Amazon, but certainly a lot of people are going to be looking on the e-commerce side to see to what extent demand has waned.
Exactly, Akiko. You know, it's a tense moment for tech earnings overall, and honestly, the read-through for Amazon from the other day is bad for Meta, which is reporting today, but the read-through from Google didn't look good either yesterday. So, you know, there are kind of a couple of things that our analysts are looking for Amazon right now. The first is, you said it, AWS. It's a stalwart of the business. It always, when growth at AWS is good for Amazon every single time. The figure I saw was 30% growth is even possible. The second thing that I think is really big is, yes, the e-commerce side. We had those Prime events. If those Prime events generated sales that actually hit the bottom line for Amazon, that could be a big win and go a really long way in getting them to the place where they prove they can be resilient in this really difficult marketplace for tech.
And finally, the other question that's always kind of looming in the background with Amazon is this big push we have seen for unions. But we're getting some reports here about at least the push to unionize in California sort of backing off. What's going on there?
So Kiko, I've actually confirmed with the NLRB that union workers at Amazon in Southern California have withdrawn their petition for an election. They were seeking representation by the Amazon Labor Union, which lost the election near Albany last week. So it's a setback for the unionization effort, to be sure. The thing that I heard from a couple of experts was that, you know, for Amazon, big win, for ALU, big loss. However, they're not expecting to necessarily see organizing stop in the Inland Empire in Southern California or across the country. It's a matter of what it looks like. Some momentum's been stripped away, but you also don't only have the Amazon Labor Union operating here at Kiko, right? The other thing to consider is that you do also have, you know, for instance, the Teamsters, who actually led that walkout in San Bernardino a few weeks ago too. So it's important to consider the unionization efforts the momentum has stalled a little bit, but I don't expect to see it stop. And it will be looming over earnings and for Amazon for some time still.
Okay, Thursday after the bell, going to be a busy one for you. Ali, thanks so much for that. Let's do a final check of the markets before we let you go. Ali just talking about Amazon earnings on Thursday, but today we're going to be looking for the big one, Meta, after the bell, and the NASDAQ already down on some of those earnings we got yesterday with Microsoft and Alphabet. Disappointing, at least for investors. That is down about 32 points right now. The Dow up 274 points. That does it for me in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.
An eye on futures ahead of the opening bell here. We've got just about 15 minutes until the start of trade. Futures currently mixed at this point. The NASDAQ is the lone gainer, while you've got the Dow and the S&P 500 in negative territory. So, question is, has the bear market hit its bottom yet, or will we continue to see short-lived rallies like last week's? For that, let's bring in Charles Schwab Chief Investment Strategist Liz Ann Saunders. Liz Ann, great to speak with you as always and get some of your insight around it. So I guess that's the question that we tee up once again, and I feel like we've discussed this time and time again of whether or not we have actually seen a bottom. But if there are three things that would actually indicate that we've hit that bottom, what would that be from your perspective?
Well, so we did check a positive box somewhat recently when the market was retesting and ultimately went through its mid-June lows. There were certain breadth indicators that actually got better. So there were fewer stocks, at new lows, even though the overall index was at a new low. That was a positive sign. Unfortunately, as the market has rallied, breadth looks kind of mediocre. So I would have liked to have seen better breadth both on the upside too. I think sentiment had gotten pretty washed out. That establishes a better outlook. But from a more macro perspective, I think what needs to stabilize probably for the worst to be in the rearview mirror would be the housing market. I would specifically look at the NIHB housing market index. Yields, I think, have to stabilize. PMIs, and then forward earnings estimates. So from a more macro perspective, that's what I'd look for to get a sense that the worst is over both for the market and the economy.
Listen, I know you're an avid earnings watcher, and we're right in the thick of things here. What has been your assessment so far?
So, weaker than the second quarter, both including energy. So right now the blended consensus, which is inclusive of companies that have already reported, so these are actual numbers blended with the consensus for those that are left to report. That's up about 3%. That's down from about 8.5% in the second quarter. If you exclude energy, you go into negative territory, about -4% versus -2% in the second quarter. So a deceleration. The beat rate is decent, but I think that's in large part due to the much lowered bar that analysts put on consensus since what was the peak in estimates for the third quarter back in the late spring.
Liz Ann, I love one of the charts that you actually shared this morning on your Twitter, and particularly it was around the US dollar's impact. And particularly within this foreign exchange FX headwind that's continued to be cited by companies over the course of this earnings season. I mean, how many earnings periods do you believe that this could still be one of those headwinds that has to be navigated by companies?
Well, if the dollar continues its ascent, then I would say the impact on earnings, which is being felt in earnest in the third quarter, doesn't go away. If for whatever reason you see a retreat in the dollar or stabilization, I think it becomes less a factor. Then you also have the possibility of companies deciding whether or not to hedge. That comes into play, but it's being felt right now. About 40% of S&P revenues and sales are directly tied to overseas sources. For big cap tech as a sort of a monolith, that's closer to 60%. And you started to hear more commentary from companies about FX impact, the strength of the dollar impact in the second quarter. Now it's even a greater force, both in terms of the hit for the third quarter, but also forward-looking commentary.
Are you surprised that expectations around rate hikes by the Fed, they look to be beginning to roll over a bit?
They are a bit. I think the estimate is starting to move down for 50 basis points in December versus 75 basis points. I think 75 basis points next week is a lock. It does show you that trend and rate of change always matters. No one would ever look at a 50 basis point hike in isolation as a more dovish stance, but it's all relative to the series of 75 basis point hikes. I think that that's natural for us to be at the point where we start to anticipate pause or at least a step down. I'm happy that the market is no longer focused on pivot to rate cuts, which was the narrative in play when the market started rallying in mid-June. Frankly, I think that narrative made no sense because the conditions to give a green light for the Fed to cut rates, I think would be much more dire economic environment and or much more significant deterioration in the labor market. So I think this shift back to, okay, maybe a step down to a pause is what we should focus on near term. That seems to me to be more appropriate.
By the time that we actually are in a recession, and of course it would be well after that perhaps that the NBER would actually determine that we were or have incurred a recession. But all of that considered, the market's going to try their best to price that in as far ahead as possible. So when does that kind of market pivot happen, even ahead of a Fed pivot, even ahead of a recession actually taking place?
I think what makes this cycle a bit different, yes, the market peaked out on January 3rd of this year, and we went into a bear market. So that obviously does reflect the combination of monetary policy tightening and the impact of tighter financial conditions on the economy, regardless of whether or not the NBER ultimately declares it a recession. I think what makes it trickier this time and could maybe elongate the process for the market digesting the economy is the rolling nature of what's been happening in the economy, almost a rolling recession where we're clearly in it with housing and many of housing related things, but the services side has been a positive offset. And that's just the nature of the pandemic, because the demand surge fueled by stimulus had to be funneled into the goods side of the economy because services were not accessible. That was the breeding ground for the inflation problem with which we're still dealing. But we're already seeing disinflation and weak demand on the goods side with the offset on the services side. So I think there's this elongated rolling nature to the economic downturn, which makes it a bit trickier. It's always tough to call the market as it relates to the economy, but trickier because of the rolling nature of this.
It just doesn't get any easier. Charles Schwab, Chief Investment Strategist, Liz Ann Saunders, always great to get your analysis. We'll talk to you soon.
Thank you. Good morning.
From New York City this morning, good morning, good morning. 3 big days of gains on the S&P 500, colliding with some negative news and sending equities lower, much lower. The countdown to the open starts right now. Live from New York City this morning, good morning, good morning. 3 big days of gains on the S&P 500, colliding with some negative news and sending equities lower, much lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Live from New York City, we begin with the big issue. Here comes the pain.
We're starting to see it.
Street has been bracing for some breakdown, for cracks to begin to show.
This dollar strength feeding through.
We're seeing margins that are beginning to come under pressure.
We do have higher input costs.
We're starting to see credit metrics largely peak.
We do have the geopolitical tensions.
Investors are just feeling pain. Corporate cash balances have fallen over the course of the year.
There's an argument you're starting to price in a mild recession.
Clearly the concern that we and everybody else is having is the Fed going to go too far?
We're starting to see some of those cracks come through.
We're starting to feel it.
Let's have that conversation right now with TD's Priya Misra. Troy Gaeski of FS Investments joins us too. We're starting to feel it, Priya. We saw it in the house price growth data yesterday in the United States. We saw it in the earnings after the close. How bad is this going to get?
I think pretty bad, and it's because the Fed really does not have the policy space to respond. So, I mean, I think we're just starting to see the cracks. Real rates extremely high, and you've got a Fed that's, they may be downshifting, and I think that's a communication challenge. They may downshift in terms of pace of hikes, but they're going to keep going. And so, and you've already had, QT, I think, putting upward pressure on real rates. So tighter financial conditions in an environment where the consumer has largely run through accumulated savings, I think is making up for a slowdown in consumer spending. A Fed that says, look, we told you it was going to be painful. And so, we're actually looking for a pretty deep recession starting at the end of next year, continuing into 24. And the Fed only can respond once inflation gets closer to that 2% level.
And
so
the
I think
we're starting to rally in response to some of that, Priya. And I just wonder, with that in mind, how comfortable are you being long the long bond, going into everything you described?
So I think, I think the bond market's starting to wake up to it. I still think a recession is not priced into the bond market. We're pricing in 120 basis points of cuts in 2024 from a 5% terminal rate. I mean, that's still very restrictive policy being priced in. I think I like owning treasuries. I think the question is, do you own the front end because the Fed's going to respond, or do you own the long end because they're not going to respond? And I think inflation is still too high, too sticky. The Fed's worried about their inflation credibility. So I actually like owning the long end. I'm a little nervous about Bank of Japan here, but I think, if we can put, yield curve control changes a little bit in the back burner, I think owning the long end, that's really where that recession risk is going to get priced in.
On that recession risk, we caught up with Mohammed Al-Arian. Take a listen to what he had to say.
The risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck because it no longer has time.
Troy, Mohammed says it's not 100% guaranteed. Priya's looking for it. What's a hard landing and what does it mean to you?
Yeah, so nothing's 100% in financial markets or the economy, but it's almost a certainty at this point. I mean, we've been stuck in this ugly environment all year where inflation's been simmering, obviously tighter financial conditions, and the probability of the Fed threading the needle now and guiding us to a soft landing is pretty close to zero. So, ultimately, what we're going through now is still more multiple compression, more financial condition tightening, driven not only by the front end action of the Fed, but also the historic pace of balance sheet shrinkage, which has already caused agency RMBS spreads to go to the widest in history, other than the global financial crisis. So that's going to trickle through markets. Obviously, you'll see wider spreads in credit. You'll see lower prices for equities. We're in the middle of a bear market rally right now. And then the next stop as we get into the recession is earnings obviously will decline. And that's been one of the bizarre things, John, about these bear market rallies is equity investors rooting for a Fed pivot driven by a recession.
Yeah.
And recessions are not good for earnings, right? Yeah. At that point, there'll be no more multiple compression, but clearly you'll have downside risk to earnings, and you'll have a lower low being made in broader markets.
Troy, I'm with you. It's kind of bizarre. Of course, the first thing you trade on is the idea that they pause, they step down in rate hikes. I get all of that. But Priya, the second thing you trade on is working out why they're pausing, why they're slowing down rate hikes. And I don't see the beautiful, wonderful, positive supply side solution here. I see demand destruction on the horizon. And if Mohammed's right, if they back off because of financial instability, Priya, that's not exactly bullish either, is it?
Right, it's not bullish for the economy, and I think it's going to continue. I think they really want to tighten financial conditions, and the issue is there are going to be big lags. I think we'll all be looking at data. We'll find some high frequency measures slowing down, but for the labor market to really tighten, and I'm a little concerned that the Fed is looking for a small rise in the unemployment rate. It might just take a while. Things could be a lot worse by the time the unemployment rate rises, because we're entering a slowdown with historic tight labor market conditions. I don't think people are waiting on the sidelines to re-enter the labor market. I think that's a structural post-COVID shift. So by the time, if the Fed's waiting for 5% unemployment rate, things could be a lot worse, because I think companies will be a little reluctant to lay off people, right away, because it's been hard to hire or retain people. And I think that's why looking at that one data point and inflation, both highly lagging indicators, is almost guaranteeing that the Fed's going to be late. And this idea that they can preemptively pause or preemptively ease, I think we have to put that behind us. QE is going to be not used anytime soon. I don't even think they're going to take rates down to zero. So I think it's going to be a muted, monetary policy response. I don't think you get much on the fiscal front too. So I think that financial condition tightening is going to continue, and it's going to get much worse. And ultimately, that does impact the economy.
Priya, Troy talked about a bear market rally, and initially I wondered whether he was talking about equities or bonds. And I know.
Good morning. I'm Rohit Chopra, the director of the Consumer Financial Protection Bureau. Across the country, Americans are back at work and working hard with the hope of saving up for a better future for themselves and their kids. Many of them worry whether they'll have enough money to pay their monthly bills. Reducing costs for families in their day-to-day lives can ease the strain, and there's so many ways that we at the CFPB are working to give them more peace of mind. And one of them is combating junk fees. Junk fees are those unavoidable, unnecessary, and surprise charges that inflate costs for families while providing little to no value or service. And these fees have been creeping across the economy for years and years, adding to our monthly bills with no real explanation. And they're impossible for families to budget for. At the CFPB, Americans are telling us that they're tired and frustrated of getting hit by junk fees in their financial lives. That's why we've been hard at work on banking fees that cost consumers tens of billions of dollars each year. And we're making progress. Banks across the country are cutting and even eliminating fees, saving families billions. This morning, the CFPB announced more actions to combat illegal and unexpected junk fees. One on surprise overdraft fees and another on surprise depositor fees. We're putting companies on notice about their obligations under law. We're taking enforcement actions, like one against a large bank for charging illegal overdraft fees, and customers will see hundreds of millions of dollars in refunds. We also sued a payments company for cramming $300 million in extra fees on families who were just trying to sign up their kids for YMCA camps, or were just registering for a charity walkathon in their community. And we're going to continue by finding ways to reduce burdens of other fees, like the billions in penalties charged by banks and credit card companies through new rules and guidance. This is real money back in the pockets of American families. It's good for them, and it's good for businesses that follow the law. I'd now like to turn it over to the president to talk more about these all-of-government efforts to tackle junk fees.
Well, good morning.
Today, my administration is announcing new actions to lower the cost of everyday living for American families, to put more money in the pockets of middle income and working class Americans, to hold big corporations accountable. And these steps will immediately start saving Americans collectively billions of dollars in unfair fees. And I'm here with the Director of the Consumer Financial Protection Bureau, Mr. Chopra, as well as the Chair of the Federal Trade Commission, Lena Khan. And we're remembering, they're members of the Competition Council that I created last year to promote competition across the economy and lower costs for families. One of the key things I've asked the Council to take on was the unfair hidden fees known as junk fees that are taking real money out of your pockets, real money out of the pockets of American families. Things like, has been mentioned, surprise banking overdraft fees, excessive credit card late fees, hidden hotel booking fees, or those huge termination charges to stop you from switching cable and internet plans to a better deal. Surprise charges that companies sneak into bills because they can. In fact, there's an entire industry that's popping up in America to help companies use complicated algorithms to hide fees that hurt consumers and help them. These things add up. Remember, we talked in the beginning of the administration about the study done, I think it was at Penn, that if an average family got a $400 in charges or bills in a month that they couldn't pay, they'd have to sell something or have to borrow the money. Well, this adds up to more than $400 for a lot of families. The way I think about it is the way, you heard me say it before, my dad used to talk about it, and so many other people talk about it around their kitchen tables. How much your monthly bills, how much do you have to pay for necessities? And is there enough left over just to have a little breathing room? We're making progress in bringing down the cost of families. And by the way, the price of gasoline continues to fall. It's down for the third week in a row. They're down $1.25 a gallon from the beginning of the summer, and gas prices in the decade before the pandemic were averaging $3.30 before the pandemic, before I got here. During the pandemic, no one was driving, so the gas prices went down. But even with historic recovery we're seeing in the economy of 10 million new jobs and unemployment of 3.5%, gas prices are continuing to go down. And because they're going down, we're making serious progress in getting prices close to what they were before the pandemic. The most common price right now in America is $3.39 a gallon. It's going to come down more. And they're going to come down even further when the oil companies agree to our demand, my demand to pass on the savings from the price of a barrel of oil, which is considerably down, to the pump, where in fact you get charged by the gallon. Each year, these junk fees in addition that companies charge cost Americans tens of billions of dollars, weighing down family budgets and making it harder for people to pay their bills. So my administration is taking action to eliminate these fees. First, imagine this. Your child outgrows his bicycle and you decide to sell it online. And someone pays you a check, pays you $30 for the bicycle or something. Days later, that check that you got paid with, that you deposited in your bank, it bounces. You didn't know it was bad, but you get charged $15. You get charged $15. It's wrong. It's ridiculous. It's unfair. My administration is making clear today it's illegal as well. Second, my administration is also making clear surprise overdraft fees are illegal. Listen to how those fees work. And some of you all know this, because you know from your everyday lives. But you pay a bill and you double check your bank account to make sure before you write the check that you have enough in your account to cover it. You've gotten the money, so you go ahead and you pay. Then it turns out your balance wasn't up to date because your bank was slow in processing other charges. And by the time the bank gets around to settling the transaction, you've overdrawn your account. You're charged an overdraft fee that runs around $35 each time. It's not your fault. The bank screwed up. You didn't, the bank did. You had a positive balance when you paid the bill. It's just simply wrong. And today my administration is making clear it's also illegal. Today's actions are going to save consumers more than $1 billion each year. And that's a lot of money back in people's pockets. As Director Chopra shared this morning, that his team is even going further, developing rules and guidance that would take credit card late fees and other banking fees that cost America's $24 billion a year, take them on. And we're just getting started. There are tens of billions of dollars in other junk fees across the economy, and I've directed my administration to reduce or eliminate them. Last week, the Federal Trade Commission started work on a rule to crack down on unfair and deceptive fees across all industries. Fees that were never disclosed. And there was no way to avoid the fee, like processing fees for concert tickets or like resort fees. When you think you're paying one price to book a hotel, and you only find out after you're checking out that there's a resort fee you never heard about that's added to your bill. And the Department of Transportation is going after unfair airline fees. Last summer, if your flight was canceled or delayed, only one top airline guaranteed that you could rebook for free, even because they're the ones that canceled, not you. You didn't fail to show up. They canceled. When Secretary Buttigieg called them out on this, about 10 airlines, now 10 airlines rebook for free. They don't charge the fee. That's progress. The Department of Transportation is working on rules that would require airlines and travel sites to disclose fees up front. Fees like things, if you want to sit next to your young child, well, guess what? Or check your baggage, or change your ticket. You're going to be surprised. They're going to charge you for that without telling you. Your ticket's going to cost a heck of a lot more. And that's not a Federal Communications Commission. They're working on a rule that would make the same thing for fees that internet companies charge, requiring them to show those costs up front. I'm not saying they can't charge it, but you got to let you know they're going to charge it. You can make a decision. Some airlines, if you want 6 more inches between you and the seat in front, you pay more money. But you don't know it until you purchase your ticket. Look, folks, these are junk fees. They're unfair, and they hit marginalized Americans the hardest, especially low-income folks and people of color. They benefit big corporations, not consumers, not working families. And that changes now. You know, we've been working this for a while. I know it's been a tough few years, but from day one, my administration was laser focused on easing the burden facing working class families and giving them, as my dad would say again, just a little breathing room. Because of the steps we've taken, the United States is in a stronger position today than any other country in the world economically. Jobs are up. People are back to work. American manufacturers are roaring back. As a matter of fact, I'm going to be heading up to Syracuse, New York, that area, where a U.S. company, Micron, is going to be investing $100 billion. I think I go day after tomorrow or the day after tomorrow. Manufacturing computer chips will put tens of thousands of Americans to work. Working hard to tame inflation with policies that bring down the cost of gasoline, home energy bills, and prescription drugs. In the meantime, we've been delivering concrete savings for working families and seniors. We've made, for example, hearing aids more affordable and available over the counter at places like Walgreens and Walmart, so that tens of millions of Americans with hearing loss don't have to pay expensive visits to specialists. It's saving people as much as $3,000 per pair of hearing aids. $3,000. We've also made it possible for tens of millions of Americans to get free or low-cost internet. If you want to get that, go to getinternet.gov. We'll lay out for you how you do it to check your eligibility to get $30 off your internet bill every month. In addition to taking action today to restrict 2 particularly egregious types of banking fees, my administration has pushed banks to reduce the fees they charge for consumers across the board. The result? 15 of the nation's 20 largest banks are voluntarily getting rid of bounce check charges entirely. We're going forward with the director's team is also developing rules for guidance that would require banks to go even further in addressing additional types of junk fees. We're working to lower prices and increase competition across the whole economy. Because when companies compete, products get better, prices go down, wages go up. We encourage innovation when that occurs, and America leads the world. It's called capitalism. I've said it before, capitalism without competition isn't capitalism, it's exploitation. Folks, there are 2 very different ways of looking at our country. One is, as I've said before, the view from Park Avenue. which says help the wealthy, and maybe that'll trickle down to everyone in the country. The other is from Scranton or Claymont, or thousands of cities across the country, like the place I grew up. The benefit and the belief that the backbone of America are people who get up every morning and work for a living, put on their shoes, get out of bed, and go to work. The middle class, they're the ones who built this country. That's who our country should work for. We're going to keep taking concrete actions like this. You're going to hear more from me on this to make sure it does. And when it does, not only are they going to do well, the wealthy will do very well as well. So folks, look, it's taken a little bit to get this competition piece moving, but there's a lot out there. It's going to change, not the lives, it's going to change the circumstance for an awful lot of hard-working middle-class folks. The idea that, if you want it, anyway, I won't go on now. You're going to hear more from me about this later. But I just think that one of the things that I think frustrates the American people is they know the world's in a bit of disarray. They know that Putin's war has imposed an awful lot of strains on Europe and the rest of the world and the United States. Everything from blocking grain shipments to oil. And they want to know, what are we doing? And there's a lot going on that we're doing. And it adds up. What I'm going to be coming back to you with is an example. I don't know if I'm going to do it from a podium or a release. But take an average family who's going to go visit their mother or father for Thanksgiving. What's the charge? Or they're going to come home from school? I mean, there's a lot of money. These are billions of dollars. It doesn't add up to billions for the individual, but adds up to $200, $300, $400 for average families. And I'm not being solicitous here. I say to the press here, a lot of you come from backgrounds like I came from. We're not poor, just regular folks. But that matters. It matters in their life. And by the way, I'm going to be working very hard to make sure that oil companies pass on the reduction in the price of a barrel of oil to the pump. So anyway, I'm optimistic. It's going to take some time. And I appreciate the frustration of the American people.
Remain seated while we wait. Thank you very much. Thank you very much. Press, we need everyone to remain seated for a moment while we wait for the play. Thank you very much, Press. Thank you.
Think we're going to stall out before we hit there. If things really hit the fan over in Europe, well, we could push through there. But in the meantime, probably have $5, $10 worth of price appreciation left in this move that we're seeing here. Let's take a quick look at the energy sector as well. Let's see if I can get that up. And energy is the outperformer of the day. And let's see, I'm not seeing, there we go. Energy is the outperformer of the day, and we can see ExxonMobil up 1%, Shell up 2%, BP up nearly as much. Really not a lot of red on this board, and some of the smaller players also feeling the love. Halliburton and Schlumberger, the oil service companies, those are each up 3%, guys.
Jared, also want to highlight Google, some news headlines swirling around their cross-app tracking on Android phones. Can you give us any sense of whether or not the stock is moving off of that?
Well, as we see here, the mega cap's under some pressure, but you might expect some of the names like Facebook to be responding negatively to the downside. Facebook was one of the hardest hit. And this is, by the way, this is a max chart. You can see this is probably a monthly candle of Facebook, but I want to dial this back down to a 1 year. When Facebook had to release its earnings, we remember this huge plunge right here. That was due to the Apple iOS rejiggering, and that's basically the same thing. So if this is to hurt Facebook in a similar manner, I think it justifies down 2.8%. We also saw some of the other streamers and companies that are dependent on internet advertising. Those took a hit as well. So all in all, we're looking at a pretty red day here. And I just want to go back to the S&P 500 so we can kind of chart where we are, because we hit a critical threshold level earlier in the morning. This is a 2-month candlestick chart. And this was the breakdown level where we saw some acceleration to the downside a few sessions ago. We came right back up to that breakdown level, and now we're basically treading water here, but it looks like we might be selling off as well. So if that's the case, probably going to revisit these lows at the very least. If we push up, there's going to be a huge short covering rally if we can get above the 2600 level, guys.
And Jared, I can't let you go without looking at the crypto space. Seeing red across the board here with Bitcoin specifically down below that $44,000 handle again.
Yes, and this has to do with some more market technicals. Bitcoin also at an important threshold. $45,000 to $46,000 has been an important threshold, and it's an important short level for those shorts who want to reinitiate their positions. So here's a 3-month view, and 46. Let me actually dial this back to a 1 year. And here we see that this level has been in play many times throughout the past. So if in fact the market is selling off, if Bitcoin is selling off from 45, 46,000, could probably retest these lows. Now, as I've been saying, we are in a very short-term uptrend. We have a series of higher highs and higher lows potentially in the making. So on a very short-term basis, the technicals could be setting up for something, but have to push through 46,000 first, guys.
Yeah, it's been interesting to see how the crypto space has reacted to some of the declines we've seen in the equities market. Jared, thanks so much for that roundup. We're going to take a quick break here. We'll be right back.
Welcome back to Yahoo Finance Live. We're getting a little bit of drift in markets on the 1 p.m. hour Eastern in markets. When you take a look across the board, S&P 500, the Dow, and the NASDAQ all in the red. The NASDAQ getting a little bit of a steeper loss today, down about 1 1/3%. All of this coming just about 55 minutes ahead of the Federal Reserve releasing their minutes covering their mid-January meeting, where you'll recall that they signaled a very strong likelihood of the first post-COVID interest rate hike coming in their March meeting. Now, it's going to be very challenging because these meeting minutes are going to come out at 2, are actually going to be preceding or covering a period that was preceding the hot inflationary report that had a lot of people repricing their expectations for the Fed. Yahoo Finance's Jared Blickery is still with us. And Jared, it seems to me like there could be a very serious headline risk to the minutes that come out at 2 p.m., given the noise and just the challenges around how to interpret it. What have you seen historically with FOMC minutes, and would you expect these specific rounds of minutes to get markets in a bit of a tizzy?
I'll tell you what, historically, the FOMC minutes do not move the market that much, except when we are around critical decision-making periods, and that's where we are right now. And it was the previous FOMC minutes, which I believe were released in early January, that really caused a lot of consternation in the market. That started the first market sell-off of the year and really accelerated markets, risk markets, to the downside. And that's when we saw the 10-year T-note yield start exploding to the upside and all kinds of chaos in the markets. And that's because everybody's wondering, first of all, is it going to be 50 basis points in March? Maybe a little bit more? I don't think so. But I think the bottom line is there's going to be a lot of attention on that. Any discussion regarding balance sheet runoff, that is quantitative tightening. But I think the real deal in this report is going to be to gauge whether or not there's a gradualist approach. And that's a word I've been seeing increasingly used over the last few days, gradualist. So is the Fed, in fact, at peak hawkishness? Are they going to try and go slow rather than just stomp on the brake here? And I think that's what's going to happen. So I think the market could react favorably to that. And then, Brian, I know you're chiding me on Twitter here for releasing charts of M2, but I think there is something to be said for global M2 money supply, which has been crashing. It's stopping, it's slowing. So all of that could be a tailwind for markets in the coming months, as I think markets wake up to the fact that the Fed is not going to be as aggressive as originally thought.
Yeah, and Jared, Brian brings up a good point. We're looking at these minutes and sort of backwards looking, even though we've gotten additional data since then. Not expecting potentially because of that a significant move, at least in the bond markets, but we're continuing to see the 10-year yield pushing above that 2% level. What's caught your eye on that front?
Well, the 10-year T-note yield, I'm not sure that it is going to press much higher in the short term. It certainly could. It's whenever it just breaks to these new highs, it has to consolidate for a little bit, and that's what we're seeing right now. This is a 2-month chart. Let me put a 6-month chart on there, and you can see even when it accelerates a little bit, there is this cooling off period. So I think we've reached one of those thresholds where we see that the market can come back a little bit, or at least not advance further. If it does, I think that's going to put more pressure on equities. And I have to reset this computer. I have to reset the interactive, it looks like. But in the meantime, I'll just close by saying I think the markets have priced in the worst right now, and there could be some additional consternation if we get a higher CPI print, but it's difficult to conceive of the market getting that much more hawkish on the Fed right now.
All right, Jared, okay, you bring up the M2 money supply, so let's get into it, shall we? Everyone knows that all the global central banks are tightening, so of course that's directionally where the money supply is going to go. So are you telling us that there's something going on in the global markets, interest rate differentials that you're worried about? Like what is it about the M2 global money supply that tells you something that we don't know?
I'm not getting that far into the weeds. It's very simple.
Come on,
but I like where your head is at here. I'm simply looking for. I see market flows are a lot more important to the functioning of the markets, the capital markets, than I think a lot of economists understand, and that's why it's always been about the flow. You take a look at what QE has done historically. It's not necessarily the monetary base, but it's in terms of the flows, the money stock that's flowing from one place to another. So bring it back to the current situation where we have these global banks in tightening mode, but there's some other dynamics here. For instance, in the U.S., the Treasury, since we lifted the debt ceiling, it's been replenishing its coffers, and that has been draining liquidity in the U.S. Well, that's coming to an end. So given the fact that the Fed is still in bond buying mode, that could add to the global liquidity situation. We know the People's Bank of China has been easing recently. So in the context of everything that's happening in the world, I think there are some independent moving parts that could add liquidity to the system that we're just not considering. ECB is still printing. BOJ is super easy right now. So all in all, even if the Fed does lift off the brakes a little bit in terms of its monetary policy hawkishness, I think that that's going to lift markets. I think that's going to be a tailwind into the latter half of the year. And that's going to be a problem for the Fed, because when the Fed realizes that they're still not ahead of inflation, that's when they're going to have to slam on the brakes. I'm talking Q4, Q1 of next year.
Yeah, well, and of course, that concern is definitely salient, but I think that the broad point about the impact of liquidity is very much an open question that we'll say is fair for debate. But of course, Federal Reserve officials, some of them, like Esther George, talking about actively selling bonds in the quantitative tightening process, which would happen later this year, as opposed to just allow maturing securities to simply roll off the balance sheet. If that happens, that could very much change the story on exactly how impactful their quantitative tightening will be on liquidity. But we'll drop it for right there, Jared. I feel like you and I have a conversation we need to have at some point down the line. Yeah, you're fine. It's Jared Blickery. Thanks so much. We'll have more market coverage on the other side of this break.
Welcome back to Yahoo Finance Live. We are seeing shares of Viacom, CBS continue to fall, I should say, in this session here. Seeing its biggest decline in almost 11 months here on the back of their earnings report, but also on the company rebranding its name to Paramount Global to focus more on streaming costs. Certainly a big concern for investors as Paramount really looks to double down on that space. Paramount CFO Naveen Chopra spoke with Yahoo Finance earlier today to discuss the company's latest moves. Take a listen.
We're very excited about being able to rebrand ViacomCBS as Paramount. Paramount has always stood for being the best, and we are on a mission to build what we believe will be one of the best streaming services, not just in terms of the content that we offer, but quite frankly, also what we ultimately deliver financially. Paramount is also obviously a very well-known global brand. It signals that we are now truly one company as opposed to ViacomCBS, which was obviously reflected the merger of two separate companies. And it gives us an opportunity to combine our trade name with our consumer brand, as Paramount Plus is, as you well know, becoming the flagship of our streaming ambitions. We now have the ability to leverage that with everything that we do from a marketing perspective. So very excited about where it's going to take us.
Naveen, it's Julie here. I want to pick up on one word that you said, that you're ultimately going to deliver financial results related to Paramount Plus. You already have revenue, obviously, tied to it. But given what we're seeing from your stock today, is it fair to say that this is a transition period, not just with the name, but financially for the company in terms of the investment period that you all are entering? And what would be your message to investors then, given that and given what we're seeing in the stock today?
Yeah, well, we are fundamentally focused on building long-term value creation, and we strongly believe that streaming is the opportunity to create immense value. We're obviously in investment mode today, but we believe it is a business that has a massive market opportunity. And our approach to pursuing that is different. And it's different in ways that we think do yield a better financial model. Just to give you a few examples, we have the ability to leverage content across multiple platforms, which makes the investments we make in content much more efficient. We have built-in promotional platforms. We have a different approach to distribution that combines the D2C model with a real embrace of bundles and partnerships. We have global production capabilities that give us very direct and efficient access to local content to use in markets around the world, all of which means an economic model where we believe we can create long-term streaming margins that approach what we see in our traditional TV media business. Or said differently, we can make streaming more efficient and have better margins at comparable scale to a traditional pure SVOD business. So it's fundamentally a different playbook, and that's what we want investors to understand as we go down this path.
I mean, let's just stay on the stock price, because I see your assets in terms of content, CBS News, I mean, just tremendous library of content. Of course, that extends to movies as well, but I see the stock is trading about 9 times forward earnings. What else can you do to get that stock price up? Can you buy back more shares? You exited the quarter with about $6.3 billion in stock. You've also been selling off non-core assets. Do you see more opportunities to unload things that may not fit with your vision?
Yeah, I mean, what we want investors to focus on is that long-term opportunity. And we've done some things, particularly with our financial reporting starting this quarter, to try to make it easier for people to understand that we bring both a very large scale, very profitable traditional media business and a high growth direct-to-consumer streaming business. And it's really the combination of those two things that translates to the overall value of the company. And we want people to look at it that way. And then we also want them to understand what I described a minute ago, which is we are building our streaming business using a different playbook. It's a playbook that we think is ultimately a better financial model. Look, it may take the street a little while to understand that, but ultimately it's just a massive opportunity and a great value creation opportunity as well.
And you guys are still, obviously, as we've been talking about, early on in that journey. I'm just looking at last quarter, and I think about 16% or so of your revenue was from the streaming business specifically. It's been growing quickly. How important, is there sort of a goal you want to get to when it comes to the streaming business in terms of the financials?
Absolutely. I mean, we spoke extensively about this in our investor event yesterday. We have very big growth plans for streaming. You pointed out that both 2021 and Q4 we posted some phenomenal growth, added 9.4 million streaming subscribers in Q4, which makes us, by the way, the fastest growing global streaming service. So we're very proud of that, but we're not stopping there. We talked yesterday about the fact that we now expect to exceed 100 million subscribers in our D2C business by 2024. We expect revenue to grow from a little over $3 billion today to over $9 billion in 2024. So we see ourselves being a very big player on the streaming stage, which, as I said, is an exciting growth opportunity for investors.
Naveen, is the streaming platform at 100 million subs by 2024, is it profitable on those levels?
Well, one of the things that we talked about yesterday was that, in addition to the growth that we expect to deliver by 2024, we think the D2C business hits its peak losses in 2023, and then earnings start to improve from that point forward on the path to a business that, as I said earlier, ultimately delivers margins that look comparable to what we see on the traditional TV media side today. That doesn't happen overnight, but building great large-scale businesses does take a little while, and we're going to continue to invest behind the growth which we're seeing. This is not just a hope. We've seen tremendous growth in 2021, and we're pushing the pedal down even more aggressively to capture that.
There was a line in the release, Naveen, that caught my attention. I think a lot of other folks in the street, that in 2024, the new theatrical releases, after you release them in theaters, you're going to put them on, I believe, Paramount Plus. Does that mean you're walking away from Netflix? How does that relationship look? Does anything change there?
Well, we don't have a relationship with Netflix specifically with respect to theatrical movies today, but we do have a relationship with Epix. And so today, when those movies go into the Pay One window, some of them go to Epix, some of them come to Paramount Plus. Once that deal comes to an end in 2024, you'll see those movies coming to Paramount Plus.
And Naveen, finally.
Hello, everyone, and welcome back to Yahoo Finance Live. I'm Alexis Christophorus here with Karina Mitchell, and Berkshire Hathaway's number 2, Charlie Munger, about to speak at the Daily Journal's annual meeting in Los Angeles. Munger, of course, is the chairman of the board of the Daily Journal, and he'll also be taking shareholder questions. And Karina, normally hundreds of investors from all over the country attend this meeting to hear Charlie.
Yeah, absolutely, Alexis. And this year, due to COVID, the meeting is being held at the Daily Journal's downtown offices in LA. It's one of those rare appearances where you get to hear Munger speak candidly about the markets and the economy. So without further ado, let's go straight to LA to hear from Charlie Munger and Daily Journal President and CEO Jerry Saltzman. Gentlemen, thank you so much. Charlie, the floor is yours.
The sole business of the meeting is to elect 4 directors: Munger, Conlon, Mary Jo Rodriguez, and John Frank. We have the proxies, we have the inspector of elections, we have everything here. That is now done. The Daily Journal's formal business is over. Now we're going to answer questions in the tradition that's come to both the Daily Journal and Berkshire Hathaway. So you're on for the first question.
CNBC, and I've been collecting shareholder questions. We'll go through as many as we can over this period, but Charlie, Jerry, we wanted to start with questions that were very specific to the Daily Journal first. First question comes in from someone who asked to remain anonymous, but the first part of the question is, how does the Daily Journal plan to handle its investment portfolio after Charlie steps back?
Charlie, I think you should answer that.
Well, I'll handle it as long as we can, and when I'm gone or sufficiently impaired, we'll get somebody else to do it.
Okay, the second part of that question is, what are the reasons for Jerry and Peter Kaufman leaving the board?
Well, we are going to have to make changes in the future because Jerry and I are so superannuated, and Peter didn't want to do it anymore, and that's all we have to say.
The next question comes in from Sarah Anderson, and again, these succession questions, I did receive several of them, so I just wanted to follow up with this one. She asks, what is the current Daily Journal's management succession plan, and who will be in charge after Mr. Salzman's retirement?
Well, our long-term plan is to replace both Jerry and I, because he's 83 and I'm 98. So obviously we have a succession planning to do in the near future, and we'll do it as fast as we can.
The next question that comes in is from someone who says he's a concerned shareholder. His name is Frankie Lamb. He says, I noticed that our company is using margin debts to purchase overseas securities, and the overseas security is not reported in the SEC filing. As a shareholder, am I entitled to know what overseas security we own on margin? Thank you for taking my question.
Well, the practice at Daily Journal and Berkshire is the same. We disclose what we have to under the rules because we don't want people to know what we're buying and selling. So we tell everybody what we have to under the rules, and we keep it confidential until then. That's our system.
This question comes in from Daniel Koenig. He says, I am a small retail shareholder from Austria, and I have basically only one question. In the latest 10Q, our company stated that Journal Technologies serves 30 states in the United States. On the website and all the other older 10Q and 10Ks, it said that JT serves 42 states. I just wonder, what is the reason for the decline? I'd appreciate any explanation.
Gary, you take that one.
The reason for the decline, to a certain degree, is several years ago, we decided not to support a very old legacy system, which had a number of smaller agencies in addition to a number of larger agencies. And as we expected, many of the smaller agencies decided not to go to our main system, which we call e-court, e-systems, e-probation, e-prosecutor, and e-public defender. And so that's the reason the decline in those numbers.
And by the way, other software companies avoid obsoleting a system because they lose some business. But we want the customers to have the more modern system.
A related follow-up question on that comes from Jim Mitchell in Costa Mesa. He says, who are your principal competitors in supplying software to court systems? And do you have a guess as to who has what market share?
Well, Journal Technologies has the big share, and the rest is scattered. Tyler Technologies has the big market share.
Jim Hall writes in and says, Mr. Munger, I've been a shareholder of the Daily Journal for over 20 years and appreciate the quality of the management and the employees in developing the business. In the annual report, you noted that the prospects in software now seem especially interesting. Would you care to expound on that thought?
Well, I'm glad to. What's interesting is that the courts of the world have been in the Stone Age, and there's no reason where lawyers should go down through heavy traffic and wait for some little motion. It should all be done on Zoom and so forth. And the filing should be done electronically. And so what there is a huge market for the automation of the courts, and it's early. That's the good news. It's a big market. And the bad news is it's a slow, damn tough way to grind ahead in software because it's very bureaucratic, RFP, government bodies, and it's a huge market, and it's intrinsically going to be very slow to get done. That's the good news and bad news. We have a huge market, and it's going to be slow and bureaucratic.
The next question comes in from Tom Seymour.
There isn't any doubt about what's going to happen. The courts are going to get more efficient and get with the modern world. And so also the district attorney's offices and the probation offices.
The next question comes from Tom Seymour. He writes in January, Jeff Gundlach was quoted, China is uninvestable, in my opinion, at this point. I've never invested in China long or short. Why is that? I don't trust the data. I don't trust the relationship between the United States and China anymore. I think that investments in China could be confiscated. I think there's a risk of that, end quote. Obviously, with a significant percentage of the Daily Journal's marketable securities invested in BYD and Alibaba, you feel differently. Please explain why you are right.
Well, of course, only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. And we invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. Other people, including Sequoia, the leading venture capital firm in the United States, have made the same decision we have. But I'm sympathetic to Gundlach. If he's nervous, he doesn't have to join us. Different folks have different opinions. I feel about Russia the way he feels about China. I don't invest in Russia, so I can't criticize Gundlach's point of view. It's just I reach a different conclusion.
Okay. This question comes in from Bill Roberts, and he says, Charlie, you and Warren have been making concentrated investments since the 1950s. Many of these investments have led to gains, but even more impressively, none of them have led to significant losses. As far as I can tell, neither one of you has lost more than a few percentage points of equity on any single investment. Daily Journal has recently bet a large amount of its capital on Alibaba and foreign traded stock. It's also taken on an additional $40 million in margin debt to make these investments. What makes you so sure that these investments won't lead to a substantial impairment of Daily Journal's equity capital, which would impact the company's ability to reinvest the resources needed to develop the company's software operating business?
Well, of course, if you invest in marketable securities, you have the risk that they'll go down and you'll lose money instead of make it. But if you hold a depreciating currency, that's losing purchasing power. On balance, we prefer the risks we have to those we're avoiding, and we don't mind a tiny little bit of margin debt.
I got lots and lots of questions on Alibaba. That was the one question that I received more than any other, so I'll dig a little deeper through some of these. Someone named Vishal Patel from Toronto wrote in and said that as a Daily Journal owner, do we own local shares of Alibaba? Does that actually give us legal ownership of that business, or do we have a variable interest, and is that the same? Net, what do we own? And I did get a series of questions related to that same sort of thought.
When you buy Alibaba, you do get a sort of a derivative, but assuming there's a reasonable honor among civilized nations, that risk doesn't seem all that big to me.
Got a lot of questions just about the investing in China risks, and I'll ask this one from Ravi Mehta. He's interested in your take on China and Chinese stock exposure for the long term. He says it's becoming quite evident that Chinese companies could be banned from doing business in the Western world or maybe some of the Eastern countries